Distinguished guests, ladies and gentlemen, the Accounting Research and Development Foundation is pleased to announce the opening of 2019 International Financial Reporting Standards Conference. We are extremely honored to have many distinguished guests attending this conference. First and foremost, I would like to invite the host of today's conference, the chairman of the Accounting Research and Development Foundation, Dr. Doris Wong, for her welcome address. Let's welcome Dr. Doris Wong.
Good afternoon, ladies and gentlemen. On behalf of the Accounting Research and Development Foundation, welcome you all to join this great event. Especially, I will thank you, our special guests, special speakers, Mr. Daryl Scott. Daryl, he is the board member of ISB, and this is the first time he visits Taiwan, and he will tell you his journey during his speech. Then I would like to thank you, the chairman of the Financial Supervisory Commission, Mr. Gu. Thank you for your coming. I would like to thank you, our accounting principal, Professor Zheng. And Professor Zheng always our principal forever. So, 郑校长，郑校是我们永远的校长啊。Then I would like to thank you, the director of the Banking Bureau, 邱局长，银行局邱局长。And I would like to thank you, Professor Liu and the National Taiwan University Professor 刘教授，刘景刘教授啊，也是我们快研基金会我们的财务准则委员会的主委哈。Today is a very special day for us. Ifrs 17 is our good friend. Why I say that? Because you live in the house, you buy the insurance for your house. You drive the car, you buy the insurance for your car. You eat the food, you buy the insurance for the food. So you need the insurance everywhere. That means this Ifrs 17 has a big audience. Not only you, everyone. Today, we also have the FB for broadcast. And so everyone over the world can see today's afternoon event. 我想这号公报是非常特别的啊。这号公报呢，其实不是只有影响保险业，影响会计师界，影响学术界啊。它其实每一个公司每一个人，只要你有买保险，它是一个不一样的啊。I think that this time we need have three things to make the implement this standard successfully. We need friendship, we need technology, we need collaboration. Why we need a friendship? We like a friend like Daryl to help us, to guide us, to implement this standard successfully. Then we need the technology because we need the smart contract. We need the artificial intelligence, we need blockchain to help us for that. I think collaboration is the most important part, and I hope you can work together and we will make this standard very good. I hope Taiwan can become one of the best practice for Ifrs 17. And thank you all for your coming. I think today you have very good result for this afternoon. Thank you very much. Thank you.
Many thanks to Dr. Doris Wong. Next, I would like to invite the chairman of the Financial Supervisory Commission, Mr. Wellington Gu, for his opening address. Let's welcome Mr. Wellington Gu.
Mr. Scott, Chairperson Wang, and Professor Zheng, distinguished guests, ladies and gentlemen, good afternoon. On behalf of the FSC, I'm delighted to welcome you to the 2019 Ifrs Conference. I feel honored to be here to give you some opening remarks today. The soundness of capital market lie in a good accounting environment. Therefore, the development of accounting standard play a crucial role for capital market. The International Financial Reporting Standard, IFRS, are not only the static regulation, but also the worldwide dynamic language. Enterprise can fairly present the financial performance through the use of IFRS. It's our great pleasure to welcome IASB board member, Mr. Daryl Scott, to deliver keynote speech to the seminar. Mr. Scott was the former member of IFRS Interpretation Committee, helping issue and the user of financial statement solve practical issue. He has taken as IASB board member since year 2010. Daryl came here today especially to share with us recent IASB project, including Conceptual Framework of Financial Reporting, Principle of Disclosure, newer insurance contract standard, and the exchange idea with Big Four audit firm on the topic of wider corporate reporting. I believe that you will have an inspiring and fruitful conference. I would like to take this opportunity to express that Taiwan has fully adopted IFRS and implemented IFRS 9, IFRS 15, and IFRS 16 on its international effective date. The IFRS adoption has broader compatibility between the financial report of foreign enterprise and those of Taiwan enterprise, which not merely lower the local enterprise overseas financing cost, but also attract foreign investors to Taiwan. In turn, increasing transparency and the competitiveness of capital market. The FSC has encountered many difficulties during the promotion of IFRS. I would like to express my sincere gratitude for the support you provided. I first would like to thank IASB for actively promoting a single global accounting language, IFRS, which contributing the transparency and the quality of financial report. On the other hand, the ARDF has been sparing numerous effort on the translation of IFRS and holding training activity, assisting local industry effectively implementing IFRS. The adoption of IFRS in Taiwan is not the end, but just the beginning. If we would enhance the dialogue and the engagement with various stakeholders and the foreign countries, the impact of new standard could be mitigated. I hope we could continue holding such international conference, keeping close relationship with IASB to keep up to date with the latest international trend. So lastly, I would like to record a Chinese saying, what a greater pleasure to have friends coming from afar. Thank Daryl for traveling long distance to be here, sharing experience with us. And also, thanks to all the staff for their hard work and attendee for your active participation. And best wish for a successful conference. Thank you.
Many thanks to Mr. Gu. Next, I am pleased to introduce a man who has become a symbolic icon of accounting in Taiwan, Dr. Ding Wang Zheng. Dr. Zheng is the chair professor of accountancy in National Zhengzhi University, Taiwan. He was also president of National Zhengzhi University today. It's our pleasure to invite Dr. Zheng for his opening speech. Ladies and gentlemen, let's welcome Dr. Zheng.
Doris, Wong, Chairman of the ARDF, Mr. Wellington Gu, Chairman of the Financial Supervisory Commission, and Mr. Daryl Scott, member of the ISB, distinguished guests, ladies and gentlemen. It is indeed a great honor for me to participate in this 2019 Ifrs Conference hosted by the Accounting Research and Development Foundation in Taipei. We are so honored to have the member of the ISB to come over here to share with the newest information with us. Gathered here in this room are all the accounting scholars, the practitioners, and the chief accounting officers of the listed companies in Taiwan. We are all concerned with the current development in financial reporting and are eager to learn the first-hand information from the authority. Taiwan has been fully adopting the Ifrs since the beginning of 2013. And in this regard, I'm proud to say that we are among the few countries and the regions in the world who have fully adopted the Ifrs as compared to other more than 100 countries in the world who have just converged to the Ifrs with more or less modifications to it or suspension of it. But we are literally converting to the Ifrs word by word. So in this regard, we should feel very proud. At the beginning, we all heard and learned that the Ifrs will offer a set of high-quality, enforceable, and globalized financial reporting standard that will result with a set of financial statements that will provide the relevant and the representational, faithful financial information. And we all think that this benefit will more than cover the big cost to transfer to the Ifrs. Over the past couple of years, empirical research conducted by the academics in Taiwan has proved that just to be true. So when the government first decided to switch to Ifrs, it met with no objections from our business community. And that, I learned that, I remember that a couple years ago when the Japanese accounting standard sitting members come over here, I asked them why you don't switch to Ifrs. And he said, no, our company feels that it's too expensive to switch to Ifrs. Okay, so we should be very proud. Now, we have been, over the past couple of years, the Accounting Research and Development Foundation, under the leadership of Doris Wong, has played an important role in promoting the accounting standard here in Taiwan and in participating in the international accounting community. This conference is a series of activities hosted by the ARDF, and we are fortunate to have Daryl Scott to come over here with us to share the first-hand information of the current development. And I am privileged to have this opportunity, to take this opportunity to introduce to you our distinguished guest, Daryl Scott. He is just the supervisor. Mr. Gu said he is currently the board member of the ISB. He became the board member in 2010. And before that position, he was the member of the Ifrs Interpretation Committee and also the Advisory Council. He was reappointed as a board member in 2015 to serve his second term. Today, Mr. Daryl Scott will share with us two important topics. One is on the Conceptual Framework for financial reporting. The newest edition just issued in March 2018. The second topic will be on the Disclosure Initiative. In 1989, the IASC, the predecessor of the ISB, issued a statement called the Framework for the Preparation and the Presentation of Financial Statement to serve as a guide for the IASC to set the accounting standards. And in 2004, the IASB initiated a revision of this concept, joined by the FSB in the United States, to develop two chapters of the new concept. One is on the objective of the general purpose of financial reporting. And the second one is the qualitative characteristics of useful financial information. The two accounting standard setting board jointly work on these two chapters, and they issued the discussion paper and the exposure draft in 2006 and 2008. After considering all the feedback from those documents and the information gathered from the outreach, they finally completed the project and issued a new conceptual framework for financial reporting in 2010. And that is we call the 2010 edition of the Conceptual Framework for Financial Reporting. In 2013, the IASB only initiated a revision, restarted the revision of this conceptual framework. It intended to make a comprehensive revision of the conceptual framework. So it issued an exposure draft and a discussion paper in 2013, and an exposure draft in 2015. And finally completed this project in last year, in March 2018. The 2018 edition of the Conceptual Framework of Financial Reporting was based on the 2010 edition, with some additions, filling the gap in some areas that were not covered in that 2010 edition, and providing some guidance that were not very clear in that edition or the old edition, and updating in some areas that were out of date. Now, Mr. Scott will elaborate on these revisions with us. The second topic is on the disclosure initiatives. As we all know that the accounting process consists of four major parts: the recognition, the measurement, the presentation, and the disclosure. The presentation and the disclosures are tools of communicating financial information to stakeholders. An effective communication of the financial information to the stakeholders can contribute to the investment decisions by the investors and also lower the cost of capital of the listed companies. An effective communication of financial information requires that enough relevant information be provided in the financial statement, but yet no irrelevant information should be included in the financial information. And also those information should be communicated effectively. That's the three important things. However, companies preparing the financial statement seem to have two types of perceptions on this regard. One is that the preparation of financial statement, the sole purpose is just to comply with the requirement of the government regulations and the Ifrs. This negative attitude or perception will render the financial information or the financial statement to be an effective communication tool. The second perception is that preparing financial information can serve as an effective communication tool to communicate useful financial information to the stakeholders. And in this regard, all companies should strive to make the communication more effective and more efficient. Therefore, the IASB launched a big project called the Better Communication of Financial Reporting, a big project that will take several years to finish. Under this big project, there's a big part that is the disclosure initiative. These disclosure initiatives also contains several projects, including the revision of IAS number 1, IAS number 2, the redefinition of the materiality that resulted in the revision of IAS 1 and IAS 8, number 8, the application of materiality to financial statements, and the standard level review of the disclosures. The IASB has identified the 7 disclosure principles that will serve as a guide for the companies when they're making the disclosure decisions. Later on, I'm sure that we'll learn more about this project from Daryl Scott. I just learned that this is Mr. Daryl Scott's first visit to Taiwan, and we ranked among 93 countries that you visited. I just make a joke that is not too late, because in the world we have more than over 160 countries. So we ranked number 93, right? That's not too bad. But we really hope that you should come here early. Well, in this regard, I do sincerely hope that you will enjoy your stay, have a pleasant stay here in Taiwan, and enjoy the hospitality that the people in Taiwan have to offer. Well, so much for my opening remarks. Now let me conclude my remarks with my sincere hope that this conference will be a great success, and all of you will enjoy it very much and benefit from it. Thank you very much.
Thanks to Dr. Zheng for his opening speech. Next, I would like to invite our honorary guest of today's conference, the board member of International Accounting Standards Board, Mr. Daryl Scott, to give us a few words. Let's welcome Mr. Daryl Scott.
Dr. Chung, Chairman Koo, Dr. Wang, thank you very much for the introductions. To distinguished guests and to everyone else in the room, good afternoon. I'm really looking forward to this afternoon, to the discussion that we're going to have. I am going to start by saying that I think the first three speakers this afternoon misled you a little bit, because the honor is mine. It is an honor to be standing in front of you, to be standing on this stage with the distinguished speakers who've just gone before me. And I look forward to the discussions that we're going to have this afternoon, and I'm excited about the things that I've got to introduce to you this afternoon. I think it's important when you think about IFRS, and I think Chairman Koo said it specifically, when you think about IFRS as a language, it is the language of financial information. It is the language that entities use to communicate their financial affairs. And it's like any language that is spoken in a lot of countries. Dr. Chung referred to the fact that IFRS is adopted over a number of countries across the world. It's over 140 countries across the world now. And you know, when a language like English is spoken in a number of different countries, it starts to develop little nuances, little differences. You speak it slightly differently in each of the countries you're in. And so an important part of why I'm here, an important part of the things that I'm going to talk to you about this afternoon, is how we can make that language mean the same things in all the different countries we can do. We use it. How we can make that language so that it is effective as a communication tool. It's interpreted the same way, and it considers the needs of everybody in all of those different countries and jurisdictions. So when I stand before you here today, I stand not just as somebody who's going to talk to you. I stand here before you because I hope that today we can open a relationship that will allow us to engage in a dialogue. I don't just want to talk, I want to listen as well. And one of the exciting things about being with the IFRS Foundation is the opportunity it gives us to speak to people in all of these countries, in all 93 of the countries that I've been to. And hopefully the opportunity is for you to tell me what works, what you love about the standards, what really makes sense about the standards, and also for you to tell me about the hard things, the things that don't work in your jurisdiction. And so that helps us to write a better standard, to write standards that work better across the world for all the jurisdictions. So I'd like to say, just as a last comment, because you're going to unfortunately be hearing a lot more from me this afternoon, so as a last comment in my opening remarks, I would like to sincerely thank the Accounting Research and Development Foundation for the logistical exercise they've gone through to bring me to the country, for all the work that every one of the team has put in to make sure that everything works perfectly, that we can have a wonderful venue and lots of people in the room today. To thank Dr. Wang for the miracles she worked to make sure that in spite of my own logistical mistakes, I managed to get here on time and be in front of you today. I look forward to a very interesting conference this afternoon. I look forward to hopefully hearing some questions from you later and having a little bit of a debate later on this afternoon. Thank you.
Thank you, Mr. Scott. Would you please stay on the stage? Next, I would like to invite Dr. Doris Wong to present the gift to Mr. Scott. Thank you, Dr. Wong. Please stay on the stage. Next, I would like to invite Dr. Ding Wang Zhen to present the gift to Mr. Daryl Scott. Thank you, Dr. Zheng. Please stay on the stage. Next, I would like to invite Mr. Wellington Gu to present the gifts to Mr. Daryl Scott. Thank you, Mr. Gu. Please stay on the stage. Now, it would be an honor if we can commemorate this moment with a group photograph. So please allow me to invite Dr. Qi-Chun Liu, the distinguished panelists Eric Guo, Ellen Yu, Shirley Chung, Elisa Li, and Director General Jing Chu, President Kitty Jing, Chief Secretary, and Secretary General Louis Wu to the stage so that we can capture this moment together. Thank you, Mr. Scott, and thanks to all the distinguished guests. Please be seated. Before we conclude this opening ceremony, I would like to introduce the sponsoring organizations for this conference. Their kind support made this event possible. Taiwan Stock Exchange Corporation, Greater Securities Market, Taiwan Futures Exchange, Taiwan Depository and Clearing Corporation, Taiwan Insurance Institute, Taiwan Insurance Guarantee Fund, Ernst & Young Taiwan, KPMG Taiwan, Deloitte Taiwan, finally, PricewaterhouseCoopers Taiwan. We would like to express our gratitude to each and every sponsor for making this event possible today. Ladies and gentlemen, this concludes our opening ceremony. Immediately after this opening ceremony, we will proceed with today's keynote speech. Our first keynote speech is by the board member of IASB, Mr. Daryl Scott. Mr. Scott became a member of the IASB in October 2010. He is also the chairman of the board's SME implementation group. Prior to joining the IASB, Mr. Scott was the chief financial officer of First Rand Banking Group, one of the largest financial institutions in South Africa. We are extremely honored to have such an experienced speaker to discuss the conceptual framework of financial reporting and primary financial statements. Ladies and gentlemen, let's welcome Mr. Daryl Scott.
I warned you I was going to be back again very quickly. All right, so I'm going to be speaking about conceptual framework this afternoon and about the disclosure initiative projects. These are an important set of projects that the IASB has done over the last couple of years and that we will continue to do over the next little while. And the really important thing about these projects is that they help in many ways set the foundation for what we are doing as the ISB, the foundation for the process that we will take forward. And as I said earlier in my opening remarks, they set the foundation for the activities that we're looking to you as part of the IFRS family to help us with as we develop over the next couple of years. So let me start by talking a little bit about what the IFRS conceptual framework actually is, what its objective is, what it sets out to do. And I think it's really important that the conceptual framework is not a standard. It is instead something as a framework that helps underpin the approach that the ISB takes to accounting standards. It was a project that was identified as a priority by our constituents when we asked them this question a couple of years ago. People told us it's really important that you have a solid framework, a solid underpin or foundation for what you do. And as Dr. Chin said earlier, this is not the first time we've invented a conceptual framework. We had one a number of years ago. It's been around for a long time. But like all things, it had become a little bit outdated. It needed to be updated and to be brought into a little bit into the modern world. And we did it in several stages over time as we developed the thinking, as we developed our solutions in the process. It was issued in March 2018 and now forms the framework that we use when we set new standards as we progress through IFRS developments. Right, so what is the framework actually? What does it mean? What's it about? What does it do there? I think there are a couple of really important things. First and foremost, the conceptual framework is a tool for me and my fellow board members to use when we develop standards. It provides us with the solid foundation, the solid place to work with. And when you think about the changes that a framework will bring, most of those changes relate to us as the ISB and the way we think about standards, because it provides that outline, that approach that we would typically use. It does also affect preparers. The community of people who are preparing financial statements will typically not look at the conceptual framework very often. The time that the conceptual framework matters for a preparer is when there is no guidance in IFRS. And so there's a couple of examples of that. Right now, we do not have formal guidance for rate-regulated activities. We don't have formal guidance for cryptocurrencies. We don't have formal guidance for gold on your balance sheet. There's a number of topics out there that there is nothing in IFRS that you can look to that tells you what to do. And if that's the case, one of the alternatives you can do is you can look to the conceptual framework and say, what does the conceptual framework tell me about dealing with that? So that helps preparers. It helps them think about, in some cases, setting standards, setting accounting policies. And then the last thing it does is it helps other people interpret an accounting standard. And very often an accounting standard, we talk in IFRS about principle-based accounting standards. We don't set laws or rules, we set principles. And sometimes when you're thinking about a principle, you have to think about specifically what the objective of that principle is. The conceptual framework helps you think about how that works. The idea with the conceptual framework is it shouldn't be too long a document. It's not meant to be thousands of pages. It's a relatively short document. It's relatively easy to read. The idea is it needs to contain sufficient detail without being too detailed, without having too much in it so that it becomes too complicated and too rules-based as an approach. So what do we do in setting the standard? I think there are a couple of important things that we had to start with. Firstly, we felt that the old conceptual framework was incomplete. So for example, the old conceptual framework provided no guidance on thinking about specific topics like measurement, as an example. So we felt that we needed to provide additional information for people to understand how to think about measurements, for us as a board to think about measurement. We also felt it was out of date. There were some things that moved on, and we had found that as we were writing new standards like IFRS 15 and IFRS 16 and IFRS 9, we were thinking differently about some things than what the old conceptual framework was telling us to think about. And we felt it was important to bring those updates through, to think about those from that perspective. And then in some cases, people struggled to understand what was included in the conceptual framework. And so it became important for us as the ISB to clarify some of the meanings that were in there. And there were a couple of really important ones. Things like stewardship. What does stewardship actually mean? Things like prudence. Things like substance over form that we felt were really important to provide more clarity. So what is the effect of the 2018 revision? Well, from the perspective of the board, for me, when I go back to London and I get involved in actually writing new standards, I get involved in the rate-regulated standards and the other ones we're working on, the conceptual framework has an immediate effect. It helps me immediately in the job that I'm doing. And so from that perspective, the conceptual framework is already a working document that's out there operating in real life. From the perspective of preparers, the ISB has given people time to think about it. So we said you don't have to apply the conceptual framework immediately. It's from 1 January 2020. And that gives you time, if you're a preparer, to think about what you need to change, to think about how you go about making that change. But obviously you'll also be affected by the work that is happening from the board perspective. So there's both a direct impact and an indirect impact from the changes to the conceptual framework. So what have we done? And what I've done for these slides, when you have a look at these slides, you'll see that I'm using the base presentation that represents conceptual framework the way it stands now, the way you would use it, the way you would operate with it. But I've marked in red on the slides what we have done about specific topics. So in this case, you'll see on this slide, there are certain things that we've clarified in the conceptual framework. But aside from those clarifications, the conceptual framework has largely remained the same. The first thing, the most important thing, is why do we even have financial reporting? What is financial reporting about? So what is the about? So what is the objective? And the objective is about providing information to the primary users of financial reports, the people who are using those financial reports for a reason, who need to make decisions about the allocation of resources. So people who use your financial statements are making decisions about your company, are making decisions about the entity, and they need information to do that. And by definition, these are people who cannot get the information anywhere else. So it's not management. Doris mentioned earlier when she did her introduction the topic of IFRS 17, and one of the things I hear a lot from insurance companies is, but I don't need this information. And I say to insurance companies, that's fine, it's not for you. Okay, the information you're preparing is for the people who are going to use your financial statements, not for the management. And it's important to think about it that way. It's people who will make decisions about whether they want to buy your shares, or hold on to your shares, or sell your shares. So it's buy, hold, and sell decisions. It's about people who want to lend you money, or want to tell you to pay back the money you've lent. So it's people making those types of economic decisions. And importantly, and we've clarified this, when I think about buy, hold, and sell, and when I think about settlement, I'm not thinking about people who are involved in the business. But many shareholders are long-term shareholders. And as long-term shareholders, they have the opportunity to vote on the strategy of the company. They have the opportunity to vote for directors, or to vote to take directors off the stage. They have the opportunity to vote for remuneration and how remuneration works. And so for them, for those votes and for those influential roles that they play, they also need information. And so we've clarified that that's an important part of the information that an entity needs. Oh, sorry, that an investor needs, that a user of financial statements needs. And they use this information to make decisions about future cash flows. So what you're looking at when you look at the financial statements of the company is what has happened in the past, and you're using what has happened in the past to make decisions about what you think is going to happen in the future. And they also need to make decisions about assessing how well management has looked after the assets of the company, how well it has managed the company. So all of these things are the important decisions that need to be conveyed by IFRS to the users of the financial statements. It is the core, the starting point of thinking about what a conceptual framework should be. So the financial framework develops a couple of fundamental characteristics that are really important that you need to think about when you are preparing financial statements. The financial statements need to be relevant, and relevant means the information in them needs to be information that will help people make decisions. So it must be capable of making a difference to the way people think about the company. So you don't put, and we'll talk a bit more about this later, you don't put useless information in your financial statements. You must put relevant information in your financial statements. And it must faithfully represent what it says it's representing. So it mustn't be misleading. It mustn't have errors in it. It mustn't be biased information. It must be information that faithfully represents the underlying phenomena that it purports to represent. Now, often there's a trade-off. Sometimes the more relevant information is difficult to be faithfully representative information. Let me give you a good example here, one of the favorite examples that almost certainly we'll be talking to you about in the next couple of years. Goodwill. Goodwill is a really important number. It tells me a lot about the company. I can't really understand Apple without understanding the value of the brand of Apple, the value of the goodwill of Apple. So it is clearly relevant information. But it is almost impossible for a company to faithfully represent the value of its goodwill. It changes every minute. It moves around. There's no place where you can find that value. So the board, previously in considering this, has decided that although the information is relevant, it can't be faithfully represented, and putting that information on the balance sheet may distort the balance sheet so that people don't really understand what's happening. By the way, I should make a statement on this quickly now while we're talking about it. I haven't actually been in accounting for as long as, for example, Dr. Chin has been, who's been around for a very long time in the accounting world. But I have been around for long enough that I can't get away from talking about a balance sheet and an income statement. I know it's got a new name, but for me its name is a balance sheet and it's an income statement, and that's the way I think. So let me apologize up front for my old way of thinking about some of these things. All right, so the trade-off is important. There are things to think about when you're applying this. So we think about the importance of comparability. I want to be able to compare a company year on year and from year on year and between one company and another. So comparability is important. The auditors have a very difficult job to do, but they need to be able to verify the information. So it needs to be verifiable information. It needs to be timely. Lloyd's of London is famous for the fact that as an insurance entity, it only produces its numbers 3 years after the book closes. Now, the problem with that approach, 3 years after the book closes, means it's really, really hard for people to understand what's happening because it's too late. I've already had to make decisions. Things have already happened. So it needs to be timely for information to be produced. And we'll talk about this a little bit later. It needs to be understandable. My old job, CFO of a bank, we used to send out our financial statements. In those days, our financial statements were 800 pages long. Okay. In South Africa, because of the nature of the way banks had developed in South Africa, they'd come from a building society basis, and so many of our shareholders were people who were not professional investors, people who had been invested in our bank for 50 years or 70 years or 100 years. And they would get this exciting letter from the post office to say, there's a package for you, and you have to just come and pick up the package. And they get all excited to go see what gift was waiting for them at the post office. And they'd get there and they'd open up what was an incomprehensible book. They had no idea. And then they'd send us a letter of complaint to say, you made me travel for this. Financial statements need to be about communicating a message, getting a message across, and we as preparers of financial statements need to think about how we make our information understandable. And then the last point on here, the cost constraint. Importantly, when you think about preparing financial statements, when you think about a standard and writing a standard, we have to consider how much it costs to prepare the information. Because sometimes the cost of preparing information is not worth the benefit that you actually get. Your benefit is not high enough for the cost. And so whenever we set standards, we consider what the cost is and how to take that cost into account. So I mentioned a couple of things that we've clarified, things that were part of the clarification. I think these words have been really important for us. The first word that's really important is prudence. Now, prudence, 70 years ago when my grandmother was at school, meant being very conservative. It meant doing things in a very conservative way. The way the ISB uses prudence does not mean that. Prudence means being careful when you are operating in conditions of uncertainty. Okay? It doesn't stop you from preparing information in an unbiased way unless a standard very specifically asks you to do it. And sometimes the standards that we write are asymmetrical. They will treat a liability slightly different to an asset. They'll treat income slightly different to an expense. But you as the people operating, you as the people preparing financial statements, when you exercise prudence, it is just about being as careful as you can to provide information that is unbiased. Measurement uncertainty is something that comes up on a frequent basis in IFRS. When we talk about financial numbers, some people in the outside world, some people who are not involved in financial accounting and accounting, assume that every number is certain. But that's not the case. Every time you put a number in your financial statements, you're making an estimate. Even simple things like property, plant, and equipment, the cost of property, plant, and equipment, or the carrying value of property, plant, and equipment, means you must estimate, if you didn't pay cash, what the value is of the thing you gave up. You must estimate the expected life. You must estimate the residual value. So wherever you go in IFRSs, wherever you go in financial accounting, you are making estimates. Estimates are not bad. Estimates are something that is good. It's a good part of accounting. But you must make every effort to make sure that the information you're providing is free from error. So you have this obligation, even though you're doing estimates, even though estimates are not bad, you have an obligation to make sure the information that you are preparing is useful information and is free from error. And of course, the more uncertain the information becomes, like the goodwill example, the more I have to think about faithful representation. The final thing that's important is substance over form. Now, this is something that's probably been abused a little bit in the old conceptual framework. What the conceptual framework says is don't just look at the words of the contract. Also look through the contract to understand what the real substance of the contract is. So sometimes I will get a motor car, I'll go and buy a motor car, and I'll sign an agreement in terms of the motor car. And the agreement says to me that I will take the car for 5 years and I will pay lease amounts for 5 years. And the top of the agreement says this is a lease, and it says I'm going to pay lease payments. But actually, at the end of 5 years, I get the car. The title is transferred into my name. I have to pay for the insurance and everything else. And then I ask the question, well, hang on a second, is that a lease just because it says it on the paper? Was that actually what we call in South Africa a hire purchase? I've actually bought it, and I've just bought it on credit. You need to look through the words in the contract to understand what the contract actually is in substance. Now, what the conceptual framework does do is it says, but be careful. Most of the time, the contract is right. Substance over form is something that is important to bear in mind, but you don't do it with every contract. Typically, you will assume that the substance and the form are the same thing. It just warns you, this is the thing you need to think about, but more often than not, the contract is what the contract says. I always find talking about elements an interesting topic. I've been involved in accountancy, as I said earlier, for a long time. And when somebody will ask me, what is an asset, what is a liability, I say, of course I know what an asset is, and of course I know what a liability is. I mean, it's easy. We're so used to the concepts, we're so used to the principles, we know exactly what these things mean. It's quite hard when you come to the conceptual framework to actually find a way to define something that we feel is very obvious, that we feel we know already. The conceptual framework goes into the detail and actually defines what an asset is and helps the board in thinking about assets and helps the board in thinking about liabilities. So an asset is a present economic resource. I have it right now. I have it in my hands. I can look at it. I can do something with it. It exists at this point in time. I control it. For an asset to be my asset, I have to have control of it. If my neighbor has a motor car and he controls his motor car, I can't call it my asset, even if he's prepared to give me a lift from time to time. It is his asset because he controls that asset. It must come from past events. Now, to be perfectly honest, I think that is redundant. It comes from the old conceptual framework. We tried to take it out, but everybody liked the idea that it came from the past events, and so we've left it in. But if it exists in the present time, it must have come into existence in the past. So it's a bit of a redundant thing, but it's there, and it helps people better understand the process. It is a right, so it must give me something. It must allow me to do something. It must give me a benefit of some kind. It's a right for me to drive the car, to sell the car, to rent the car out. Those are all rights. And very often assets are a bundle of rights, so not just one thing. If I own a car, I have the right to drive it, the right to rent it, the right to lease it out to someone. I've got lots of rights that go with it, the right to sell it. And it must have the potential to produce future benefits. So it must be able to give me something in the future. A liability is just the other side. It's a present obligation, so it's an obligation that exists in the current time. Again, as a result of past events, so I'd say the same thing. I think that's redundant, but it's there to help people who are using it. That will force me to transfer an economic resource in the future. So the one gives me something, a liability, I have to give up something, anything. And importantly, the new bit on the liability is there must be no practical ability to avoid the transfer. Now, this is important. In many circumstances, in the old conceptual framework, companies would say that they do not have a liability because it has not yet become a present obligation. The event that will occur to make it a liability hasn't occurred yet. But they're very happy to tell you that there is no ways they can avoid that event. That event is going to happen. They cannot avoid it. So we've added this into the conceptual framework so we can think about the fact that if you can't avoid something, it must be a liability. And of course, to recognize an element, to recognize an asset or a liability, there are a couple of important points. Now we start pulling the things together. It must meet a definition of an asset or meet a definition of liability. So it must be one of those elements that I've identified. It must be relevant and it must faithfully represent. So I must be able to, from a relevance perspective, I must be able to cover the question of whether it actually exists. Does it exist or does it not? On the faithful representation, I must be able to measure it and to recognize it. So all of these things now start coming together to help me actually decide whether I have an asset or liability. And then, of course, cost constraint kicks in again here. So I go back to my example of Apple and Apple's goodwill. Even if Apple could produce a goodwill number, it might be so expensive for them to do it that even though it exists as an asset, it is relevant, and I could argue it faithfully represents, it may just be too expensive, so it fails that test. And usually when we're writing a standard, this red block on the bottom is important. When we write a standard, we will think about all of those things and decide whether or not it's appropriate to recognize an asset or liability. So here's an example, just a very quick one to help you think about this a little bit. So an entity has developed a process for producing a raw material, a new material. It has not patented the process. Now, if any of you are looking for an example, I think Coca-Cola is still a very good example of this. So Coca-Cola's process is its secret recipe. Okay, it hasn't got a patent for that secret recipe. Anybody can make Coca-Cola, but you need to know the secret recipe. And without the secret recipe, tough luck, you're going to end up with Pepsi or something else that tastes a little bit like Coca-Cola, but not quite there. So this is an example of a process that somebody has developed that, in this case, this example is not in commercial production, so they haven't yet started to use it for anything. And they think that there's a large likelihood of different outcomes that might come about because they don't know how successful the product will be, and it's very difficult to estimate those. So let's ask the question, does the entity have a right? Does Coca-Cola have a right to something? It has a right to its recipe. As long as that recipe is a secret, no one else can use the recipe. It is a right. So it has a right. Does it have the potential to produce future economic benefits? Of course it does. So that's definitely. Does Coca-Cola control its recipe? It's in a safe. Apparently only one person has the key to the safe. Okay, so it controls access, it controls the use of it. And of course the redundant one, does it arise as a result of past events? Yes, it does. So the entity does have an asset in this circumstance, and we would conclude that yes. Now I just want to see. The question here would be, and this is the important question for Coca-Cola like it is for Apple, at the standard level, we would decide if you should recognize this. And remember all of the caveats we said. We said it's very uncertain. We said we don't know if they'll be able to get the valuation. So clearly it's an asset. But now you go to IAS 38, and IAS 38 sets certain hurdles for whether or not you can recognize that asset, whether you can bring it onto the balance sheet. Okay, this is an example that's given us all gray hair. I used to have beautiful dark hair with hair on top of my head until I started working with this example and all fell out. Levies is a very difficult situation that has arisen internationally. Many banking environments charge banks levies, and those levies are based on their revenue or their assets for the year. So let's say it's based on 2010. Those levies are based on their 2010 revenues, and based on those 2010 revenues, they will have to pay a levy. But the conditions in this particular levy are that they only pay the levy on the first day of the next year if they are still in business on the first day of the next year. So they have to be in business on the first day of the next year. That means there is not yet, in the old context, a present obligation, because they haven't met the condition. They're not in business tomorrow. We're talking about their business today. And so they haven't met that condition. So the question is, do we have a liability under the new definition? Is there the potential to require the transfer of is it potentially valid that it will have to pay the levy? Absolutely. Is there no practical ability to avoid? So can this company choose not to be in business tomorrow? Well, not really. It's really, really hard to expect that the company, in a practical sense, will close down at midnight tonight, unless you know it's going to close down at midnight. But almost certainly you will have to make the payment. So that suggests that it is likely you will conclude that you cannot avoid this number. And it arises from past events. So as this stands at the moment, this levy will be a liability in most likely in the company's accounts. And that is different from what we've concluded under IFRS 21. So IFRS 21, which applies the old conceptual framework, said, heck no, this is not a liability, because you haven't yet satisfied that condition. The new conceptual framework says you can't avoid satisfying it. Therefore, it must be a liability. It is more nuanced. It's one of the more difficult problems in accounting, this one, so there are nuances. But this is an important difference introduced by IFRS, by the new conceptual framework. All right, the other elements of financial statements, we've talked about assets, we've talked about liabilities. The next element that's important is equity. And equity stays what equity has always been. It is the residual. It's the amount that's left over to make the balance sheet balance. So this has always been the toughest part about being an accountant, is you can do all the clever things you like, but if it doesn't balance at the end, you failed. Okay. Your journal entries have to balance, and one of the hardest things as a board member when you're out there setting standards is I'm an old school accountant, so I do my little T accounts next to everything I'm working on. And I know there's a problem if I can figure out the debits but not the credits, or I can figure out the credits but not the debits. Because at the end of the day, that's the thing that brings us back to the truth in accounting. So assets equals equity plus liabilities. Okay, that is the truth that operates in the world we operate in. We are busy with a project at the moment, the Financial Instruments with Characteristics of Equity, or the FICE project. The FICE project is about us looking at what the characteristics of equity will be. Now, I have a confession to make here. Before I became the CFO at the bank that I worked at in South Africa, I used to be essentially a structuring person in the bank. My job was to structure transactions. I did lots of tax structuring, and that's fine. I feel fine about the tax structuring. But I also did some accounting structuring. So what would happen is a customer would come in and would say to me, I need $1 million. And I say, great, I can organize $1 million, we're happy to lend you the money. Do you want it to be equity or do you want it to be a liability? I can make it either one. You just tell me what you want and I'll make it like that for you. We have to fix that. Okay. There are ways that people write transactions, preference shares, non-redeemable preference shares being the most famous one, where essentially a non-redeemable preference share is many circumstances acts like, looks like, tastes like debt, but it's treated like equity. It's one of those things from an IFRS perspective we are trying to address, and FICE is our important project to do that. And then income and expenses are simply defined as the changes in assets and liabilities. So the change in assets from one period to another, if the assets go up, that's an income. If the assets go down, that's an expense. So these two are drawn from the definitions of the others, and that's continued in the new conceptual framework. This red bar on the bottom is really important. A lot of people think that because we define an asset and a liability first, and then we define an expense and an income as a function of assets and liabilities, therefore that means assets and liabilities are more important and income and expenses are less. That is not the case from the ISB perspective. It's not the way we think about it. We felt it was important to set the base, and we felt that assets and liabilities are easier to identify and to work with and to explain. And then we felt that left us with saying that income and expenses are the reverse of that. Equally, you could explain the income and expenses and say an income results in an asset, an expense results in the reduction of an asset or the creation of a liability. But from an ease of process perspective, we chose this particular route. Measurement is new. It's a new section. This is the one that we've added to IFRS, to the conceptual framework, so it's important to know that it's one of the changes we've made. IFRS is a mixed measurement model, meaning we use different types of measurement for different things. All board members at the ISB are restricted. We cannot work at the ISB for longer than 10 years. So 10 years, end of day, that's it, you're out the door, new board members come in. When I started the ISB, I didn't necessarily understand why this was a good idea. I've been at the ISB now for 8 years, and I'm starting to understand. The reason why it's good is because the longer you are at the ISB, the more you think fair value is the solution to everything. And so they have to chuck us out the door before we make the change, before we finally get to that point. Okay. Why do I say fair value is the answer to everything? Well, if we had one model for fair value, it would be one measurement model. You wouldn't have to think about anything else. All you would do is fair value. Everything would balance automatically. There would be none of the anomalies like Apple's goodwill or Coke's patent. You just say, what's the fair value? Boom, done, finished. End of story. The problem is, and this is why it's important that people come into the ISB from the real world, people come into the ISB from places where they're doing things and working with numbers, is fair value is hard. Okay, and fair value is often inaccurate, and fair value is often misleading. But gee, I tell you what, after 8 years, it's tempting. Okay, so that's one of the bigger things there. But so from the ISB's perspective, we've identified in the conceptual framework that there are at least 2 types of measurement technique. There's amortized cost that looks back at the history, looks at the events that have happened in the past and uses those events to ascribe a value. And then there are the current value approaches that look forward. They look to the future. They look to what's going to happen with that asset or liability in the future. And they use that future information to determine what the value is. And clearly what those are looking at is they're looking point in time. So history looks back to whenever it happened. Current values look at today, at your best assumption today of what's going to happen in the future. And importantly, they give you different information. So if I look at the information of an asset purchased at cost, it tells me at cost about the margins my business is making, how my business has evolved over time, how that money I spent in the past has benefited me in producing new business now. If I look at current value, it's telling me about events in the outside world, what the changes in prices are, what the value is of something right now. So they provide 2 different types of information. And I think that's why it's important in talking about how you select the basis, that the ISB said there were a couple of really important things. how are you going to get value from that asset or that liability? If your objective is to sell the asset or is to sell the liability, then thinking more about fair value or current valuation makes sense. On the other hand, if your objective is to use the asset up, then margin type information is more important. Revaluing an asset the whole time to the price you can sell it for, if you're never going to sell it, is not always useful information. So thinking about how you use it. Thinking about measurement inconsistencies and measurement certainty. So if an asset is very easy to measure, you would be leaning towards fair value. But if it's very difficult to measure, like goodwill, you would lean towards amortized cost. So you're thinking about all of these things as you develop an answer for this. Presentation and disclosure. The framework talks a little bit about presentation disclosure, and this leads us a little bit into the discussion we'll be having for the rest of the afternoon. It's the starting point for it. So when developing presentation and disclosure from an ISB perspective, from the conceptual framework perspective, you always need to think about how to provide the preparer of the information with enough flexibility to be able to effectively communicate their story. Remember what we said about understandability? They must be able to effectively communicate their story. But at the same time, many investors, many users of financial statements want to be able to compare one set of financial statements to another. So we need to balance between comparability on the one side and flexibility on the other side. If we were just worrying about comparability, we would give you a list and say, these are the 25 things you must disclose. This is the table you must put those 25 things into. Okay? And it must always be these 25 things in this order. If we're thinking about usefulness, we would say to you, only put the things in that list that you think, into that list that you think would be useful for somebody else to understand. But that might mean that Bank A might have a different table to Bank B. Or Bank A might in fact have a graph and Bank B has a table. So the different ways of producing that information. But we think we can provide enough information by providing objectives to people, and we will talk about this a little bit later, to help people understand how better they can do that, how easily they can do that. We also provide some information on what effective communication principles are. The most important thing we like to say is provide company-specific information. When I put information into my financial statements that's not relevant to my company, it's relevant to the whole world or the whole jurisdiction or the whole industry, lots and lots of people, if you go and look at their accounting policies, you'll see they've copy-pasted from IFRS standards. That's not useful. It's boilerplate. Go and read almost anybody's pension disclosures. It's nonsensical because it doesn't actually tell you things in many cases. So we're trying to use this to push people away from the idea of using boilerplate information. Ooh, jeez. So somebody was deciding that it's about time I stopped talking, I think. So I think the next slide I was about to go to was slide 25. The last thing I want to talk about under the conceptual framework is this whole idea of OCI and profit or loss. So we have chosen to keep OCI and profit and loss in the financial statements and hence in the conceptual framework. It means we have designed a concept or an idea in the conceptual framework for OCI. Now, a lot of people didn't like us doing that. A lot of people thought that wasn't a good idea. And one of the things that the ISB has promised to do, if you have a look at, is it on this page? I'll get back to it later. One of the things we've decided to do is to try and promote investors, promote other analysts to look at OCI. It's an important number. There was a restaurant stroke pub in Johannesburg across the road from my office. And it had it stood on the main road, and it had this beautiful parking lot in the front. And then it had a really lousy parking lot at the back where you parked in the dust out of the sight of everybody. It was a horrible parking lot. And so what they did was they put somebody at the front gate, and the person at the front gate would have a look, and if you arrived there and you were in a Ferrari or a Lamborghini or a really nice BMW, he'd bring you into the nice parking lot. And if I was in my old Toyota, he would send me around to the back. You say, you can park on that side. Okay. That's just like OCI. OCI sometimes is like the parking at the back. Okay. If you wanted to understand the people in the restaurant, if you wanted to know who was going to be there, you needed to know about the cars in the front and the cars at the back. Because if you were fooled and you thought the only people there were the ones with the cars in the front, you were going to get a surprise. It's the same with IFRS. OCI forms a very important role. It does an important thing. It allows people to remove certain numbers from their financial statements, and the ISB thinks very hard about which numbers go to OCI. But the important thing is you need to know what's in OCI to understand the company. You can't ignore that number. So we say that the first and most important, the primary information about the performance of the entity is profit and loss. And things should always go to profit and loss unless the ISB specifically says you should take them somewhere else. Okay. So that's the starting point on profit and loss. On OCI, we say whenever something goes into OCI, it should always recycle unless the ISB says differently. We think it must always come back to profit and loss somewhere in the future. Those are the concepts around IFRS, around OCI. Now, people will know. We don't always live up to this. There are things that we need to look at. We don't recycle OCI on equity, for example. That's IFRS 9. That's new. So we need to think about some of these things longer term in the context of the conceptual framework. But the conceptual framework says almost never goes to OCI, and when it does, it must recycle. So it must come back into the income statement. All right, so that leads us quite neatly into better communication, and the rest of the afternoon now is going to be about better communication in financial reporting. And I think Dr. Chin set this up very nicely when you were talking about what better communication means. This is the big project. This is a central theme of the board's work. This is something we've been working on now since our chairman's second term started, so about 4 years ago. We've identified that one of the biggest problems is how financial statements communicate. Do you remember when I told you the story about the grandmother who gets the 800-page financial statements in the post? This is the problem we got to fix. And when I left my old company, when my chairman said goodbye to me at the old company, the chairman said, look, if there's one thing you can look at, please look at this financial statement thing. He said, I'm the chairman of the company. He said, I come into the office 5 times a month. I look at pages and pages and pages of financial reports every month to understand how to make the decisions about this company. And then I pick up the financial statements and I read them. I think, what's all this rubbish? Where did this all come from? I don't know this. Which company is this? He says we need to find a way that the information that is important for running the business and understanding and investing in the business is the information that goes into the financial statements. And we need to make sure that there's not stuff in there that is not useful, that is not handy for using in financial statements. So that's what this project is. It's split up into a couple of different categories, and we'll talk about each of those in turn. So the first one is the primary financial statements. Primary financial statements, for those unfamiliar with IFRS speak, is the balance sheet, income statement, cash flow statement, statement of changes in equity. In the insurance project, for anybody who's involved in insurance, some of us are thinking maybe there's a 5th primary statement for insurance companies, which is the statement of changes in CSM. So CSM is a really important number in an insurance company. So maybe that's there. So these are the ones that you see first and foremost when you look at a company. And many people don't get very far beyond this. So primary financial statements up front, that first information you get. The disclosure initiative primarily talks about the notes to the financial statements, all the footnotes that range through the whole book. This is where a lot of the length comes from. This is where a lot of the additional information comes in. But the disclosure initiative also talks more broadly about how you actually communicate, what your objectives of communication are, how you do things like reduce duplication and the like. Management commentary, we'll talk about in the panel discussion this afternoon. So I will just give a very brief introduction at the end of my second presentation. And then Ifrs Taxonomy is about how you deliver financial information. We are increasingly living in an electronic world. People are not sitting down and reading financial statements from page 1 to page 800. Okay. In the old days, when I used to produce my 800-page set of financial statements, we used to sit at the printers on the night before, 2 nights before the financial statements were ready to go out. And we always used to say, you know what we should do is on the second last page, we should put a paragraph in there. And that paragraph would say, if you're still reading now, then phone this number and we'll take you out to lunch. Okay. The only reason we didn't do it is we were scared of what kind of person would still be reading. And that wasn't the person maybe that we wanted to go out to lunch with. But that was because the way people think about financial statements is I'll pick it up and I'll read from page 1 and I'll read all the way to page 800. Electronically, that's not the way people are consuming our information anymore. If I want to know about the lunch invitation, I will just type lunch. And it'll come up and I'll get that information immediately. If I want to know about any other specific part, I will do that. And so this delivery means that from an ISB perspective, we're starting to think differently about how information is prepared. It's not linear anymore. You access it how you want to access it. So primary financial statements, the first topic we'll talk about. This is a project we started in 2015. It's been moving along since then. That was when, 2015 was when the agenda consultation said this was important. It's been moving since then, and we've discussed all the way through to now. We intend publishing a document at the end of this year. Now, these slides were sent out 2 weeks ago. In the meantime, since they were sent out, we've actually made the decision that we're going to publish an exposure draft, not a discussion paper. So we're comfortable that we have enough clarity to move towards finalization of the topic. So this is a little bit out of date in terms of slides. What are the big things we're trying to deal with? We hear from the perspective of many users of financial statements that the information is not comparable enough. The information that companies use, like that users use, like EBITDA, is not comparable enough between entities. We hear from users that non-GAAP information, okay, is useful. Non-GAAP information helps them understand the perspective of management. But they worry about non-GAAP information because they think that there is no discipline. There's no fixed approach to the way people prepare it. People change their minds every year and put new things in and take things out. And so users are concerned about this lack of transparency, this lack of discipline. But companies continue to tell us that they need this flexibility to tell the story. They need to be able to describe their business in a way that makes sense to them as well as to people investing on the outside. And then users, investors in companies and others, think that there is insufficient discipline around disaggregation. Now, if you want to do an exercise out of interest, go pick any big company's financial statements. Ideally, pick it in an electronic format so that you can do a search, and then search for the word other. Okay. Other comes up a lot. And sometimes other is a very big number. But other is not very helpful. I don't know what other is. This is an example of disaggregation that worries people. Now, we don't necessarily think that we need to have more disaggregation. We think we need to have better disaggregation. So very often when you look at that same set of financial statements, you'll find some tiny little numbers with a label next to them that describes exactly what that is, and some very big numbers that are called other. So getting that discipline around disaggregation is important for this project. Okay, well, I may need to call on Doris to exercise some of her miracles again. My slideshow is getting a mind of its own. So what is the project about? The project is going to be about looking at a couple of parts of the, thank you. There we go. The project is about looking at a couple of specific statements. We're looking specifically at the statements of financial performance, what I used to call the income statement and the statement of OCI. We're looking at the statement of cash flows, and then we're looking at how we can improve the disaggregation that happens in financial statements. So the way we want to do that, when I think at the first instance about the statement of profit and loss, is what we think has been really important, what we've heard about from a lot of people. If I speak to analysts, if I speak to credit people and others, the starting point for them are a couple of very specific points on the financial statements, on the income statement that they go to first. Operating profit is a really important number for users of financial statements. Now, every company out there defines operating profit differently. So in our exposure draft, we're going to propose a very specific definition of operating profit. And operating profit essentially includes the investment activities. It excludes the borrowing activities. And for the sake of this, in terms of our proposal, it will exclude the share of income from associates. Now, that's an interesting one, and the board has spent a lot of time talking about it, because you can imagine circumstances in which the earnings from associates is an important part of your operating activities. The problem is it's a net number, and everything else in operating profit is a gross number. So I don't show my revenue earned by my associate or my expenses shown by my associate. So anybody, any user of financial statements who is focused on ratios and margins and the like will find it very distorted if this line's above the line. So we start with this operating idea: exclude financing, exclude investing, exclude this income from associates. And then I add on the number from associates. So I add that into the number now so that you can understand what the total operating outcome is of the company. Now again, there's an important split here. You have to think differently about integral associates. What is an integral associate? An integral associate is an associate that shares my brand name, that is a key part of my distribution network, or a key part of my manufacturing network. So oil companies very often have pipelines that are an essential part, but they will share the pipeline with 2 other oil companies. So it's treated in their accounts as an associate, but it's an integral associate. It's critical to their business, and so it would be part of their operating results. A non-integral associate, well, one of the things I used to do when we were in the banking environment is we used to very often invest in associates as either an investment strategy, so we would buy them now, we'd sell them in 5 years' time, or invest in them just because we thought they would be a good producer of money. We thought they would give us good cash flows. It didn't matter to our business. We could sell it tomorrow. It wouldn't make a difference to our business at all. That is not an integral associate, so it's not part of your operating profit. And then we split out, we've got the separate second line. The next line on your income statement is going to be earnings before financing costs. So earnings before the financing and income tax. These 3 line items, or at least 2 of them, operating income and profit before financing and income tax, are numbers that are considered critically important for users of financial statements who are trying to estimate what your future cash flows are going to be. And so by bringing these into IFRS, by specifying these lines, what it allows the ISB to do is to have comparability between companies so that users are not going out there and trying to make up these numbers, trying to figure out what these numbers are. And they're not accepting what they're given by preparers, which very often is inconsistent. So this is an important change in terms of what we're doing from the ISB perspective. You can see the arrow up the right-hand side there is important. We define the income statement then from the bottom in thinking about this. So it's an important different way of thinking about it. And so an income statement is going to look roughly like this. Now, I'm not going to go into the detail here, but if you like me, a numbers person, it's always useful to actually see the numbers and see how they work out. Importantly, if we exclude investment activities from operating income, and we exclude the financing costs of borrowing money from operating income, the results of a bank and an insurance company and an investment company are going to look really weird, because all of the stuff that they really do is not operating. So in order to do this, we've made an exception, and I'm not going to go into the details of the exception because like any exception, it is detailed orientated. But we've essentially said that if your main business is providing finance to customers, you will think differently about where interest goes. If you pay insurance finance expenses, you need to think differently about that allocation. Those things, the core parts of an insurer's business, the core parts of a bank's business, must now move from the bottom up to the top. So these are the exceptions to the process. We have not been able to define this in a principle-based method, so we've had to say, if you're lending, if you borrow in insurance, if you're investing, those 3 activities as a core part of your activity means that you're different from the norm, and therefore you must do this approach. Okay, so the next really controversial one is when we start talking about flexibility to tell my company story. So this is about trying to allow what used to be called, or what are called right now, non-GAAP measures, what we call management performance measure. This is a number that represents how management sees the business. Now, I had this number on my income statement in my bank, in the bank I worked for. Okay. We decided, we as a company, we were owned by, the main owners of the company were the original people who started it. So they owned 40% of the company. In banking, it's very difficult very often to operate a bank without having share options as part of your business. And so we had share options for staff. But our owners of the company did not want to be diluted. So they insisted that the company went out and borrowed money on the market and used that money to buy shares in the market to put into a share trust. And if that share trust went bang, then it was the person who had lent us the money that had the problem, not us. But because of control, and because of the way control works, and because of the benefit for the company, we consolidated that in, and suddenly we had share option accounting. And the owners of the company said, okay, we accept that's the rule, we're going to go with that rule. But because the company is not exposed to losses on this, and because it is set up independently, and because our objective was not to dilute, we also want you to show what the results would have been if we hadn't consolidated those numbers in. And so we had an alternative performance measurement. Is it a good one? I don't know. I obviously thought so at the time, but I think the judgment is out on that. But we did it. IFRS says, you know what? Actually, this gives you information about management. It tells you what management is thinking. There is information content in this, even if it is not a useful number. So if, for example, I decide to present an APM, an alternative performance measure, or management performance measure, that excludes my expenses that I pay for directors' travel, that tells me something about management. If I exclude sales from parts of the business that are failing, that tells me something about the way management thinks about the business. So it provides additional information, and it gives me insight into management, insight into the way management thinks. So we think it is important to include this and to put a proper framework around it. So this would allow you to calculate almost any number you like. But the other side of the equation is, how do we make this and keep this useful? Well, we listened to what the users said too. They said they want more transparency. They said they want more discipline. So if you do this, you will have to reconcile the number. You will have to show how you achieved the number by reconciling it back to the income statement as part of your audited financials. So it is a robust number that has some discipline around it. You have to disclose what the effect would be. If you rolled that number all the way down to the bottom line, what would the effect be on the bottom line? Don't just stop at the top here. Roll it all the way through and show what the effect is on everything. You have to describe why this is a good way to understand your business. And you have to label these things properly. So we've added the discipline around the outside to help people better understand the process. Statement of cash flows. We've done a little bit of work there. The most important thing for us in the statement of cash flows is to remove all the options. So there were options on everything. Interest paid could be operating or financing. Going forward, it will have to be financing unless you are a financial entity. Okay. Dividends paid, interest received, dividends received, all had multiple categories. Going forward, the proposal is that they will all have a single category unless you're a financial institution. Then the last one is this insufficient disaggregation. And interestingly, this slide captures what we've done. We've provided guidelines, we've provided information, we've talked specifically about how you would do it. We're going to develop illustrative financial statements to help people apply a more reasonable format. So we're doing all that sort of stuff. Importantly, what sometimes gets lost here is this is not just about disaggregating more. It's about disaggregating more when that is useful, and it's about disaggregating less when it would be useful to provide less information. And one of the important considerations, and we'll talk about it a little bit later too, is for us to move away from the idea that more is always better. Sometimes too much information hides the important stuff. You've got so much information in there. Go back to my old company. We had a defined benefit pension fund for about 150 employees. They were the old employees who were still around that had this defined benefit. We had closed the fund 50 years ago, but they were still on the system. They were still there. That thing was like 12 pages of notes. Nobody was going to find what they needed in 12 pages. And when they got to the bottom of 12 pages, they'd look at the bottom line number and say, but this isn't even important. It's not big enough to matter. So the idea of making sure that you put in what's important, but take out what's not important as well. All right, so that is the end of the first session. We're going to bounce straight into the next one. Is that right?
Yes, of course. Thank you, Mr. Daryl Scott.
So shall I just keep pressing and I'll get straight into the next one, or? I'm scared to press this now, because it's like Grand Prix racing where it sort of runs away from you. So the next two presentations we're going to talk about, I'll just give you a heads up on it anyway. So the next one is going to be on the Disclosure Initiative and drill down a little bit more into what we're doing on the Disclosure Initiative. And again, this is an important project. And again, what's important about what we've just spoken about, and what's going to be important about this new project, is that in a couple of months' time, we are going to be asking you for what you think. Do you remember what I said when we introduced it? I said this is going to be a dialogue. And an important part of this dialogue is for you to tell me what you think so that I can decide, I can think about whether I've got it right or not. These are going to be an important part of those dialogue discussions. Thank you. Okay, so that felt a bit weird. So hey, I'm back. But thank you for the applause. All right, so going into the Disclosure Initiative then. And this again is that better communication. You'll remember this slide that we spoke about earlier. So we've dealt with the first part, primary financial statements. We're now moving on to the second part, the Disclosure Initiative. I'm going to talk about that a little bit. Let me just get this open here. Okay, so in talking about the Disclosure Initiative, a couple of important things. When we started to discuss the Disclosure Initiative, the first thing we identified as a problem was that there was too much irrelevant financial information. Do you remember my 800 pages financial statements? We identified that there was too much stuff in there. People's financial statements were getting too long. We had to make them shorter. When we started exploring this, though, when we dug a little bit deeper into this, what we found was that that was only one part of the problem, was only the first pillar. Because there was also very often not missing information in the financial statements. Things had been left out of the financial statements. And then importantly, just as relevant was the third category there, the ineffective communication. So what you would find is the same thing would be repeated 4 times in a set of financial statements. Or if you wanted to understand, and I plead guilty, if I wanted to understand my bank's advances, I would go to a note that would tell me about all of my lending products that were carried at amortized cost. And then it would finish. Then I go back to the front, and then I'd find I had to go to a different note to find out about all the stuff at fair value. And then I go back to the front again, I go to a different note to find out about all the stuff at fair value OCI. And then I had to go back to the front again to find out about impairments. And I went to a different place to find out about impairments. But if I wanted to understand where the information was coming from, I had to go to a completely different place again to read the accounting policy note. Or if I wanted to understand how I was managing those assets, I'd have to go to a different place to find out about the risk management policies. The stuff was all over the financial statements. And unless you knew how to look for it, you were going to spend a whole day adventuring around these balance sheet and notes and etc. And so effective communication is one of the problems that we've got with the way the way people interpret IFRSs as requiring them to do things. So when we talk about IFRSs, when we talk about what we're changing in the Disclosure Initiative, these are the main projects that we've completed so far already. And I'm going to first touch on the bottom 2 on this page, because I've got more slides on the other ones. We made some amendments to IS1 to remove barriers for people in understanding how they presented their financial statements. Now, I mentioned an important example earlier. People were reading IS1 to say, I had to have my 25 pages of accounting policies. Then I had to have my note on advances. Then I had to have my note on impairments. Okay. We were saying, no, gee, guys, that's crazy. We've seen some really good financial statements where they put all of the information about one line item together. So I go to the advances one. It tells me how I calculated advances. It tells me how I manage the advances. And it tells me what the impairments are. People reading into IS1, they couldn't do that, so we've changed IS1 to allow you to organize your financial statements to make them easier to use. We've added some changes to IS7 to help people better reconcile liabilities. Now, this is an interesting one because typically this was information that was available in the financial statements, but it was spread all over. And investors told us this was a really important part of the information that they use. And so we've provided this as additional information to help investors. To talk about a couple of the others, we have amended IS1 and IS8 to better define what materiality is. And information is material if omitting, misstating, or obscuring. I love the little bits in brackets because I've never seen those before, and that's something new for me. So omitting, misstating, or obscuring, and the people who helped me with the slides have picked up that those are the important words, and they spot on. Those are the important words. So omitting, if you leave it out, people will not be able to, or what's the other phrase that we use? People could reasonably be expected to need that information, so they will miss that information in the decisions they're making. If you misstate it, that's clearly a problem. You put the wrong information in. But just as important, we've added obscuring. So if you hide the information by putting lots of rubbish in your financial statements, you have also not done what the requirement is here. So reasonably expected to influence is important. It's not an absolute. It's an assessment, a judgment that you make. Obscuring, don't hide stuff by putting too much other stuff in. And we use the same wording now throughout IFRSs, so in the Conceptual Framework and in all of the standards, so it's a consistent understanding. This change looks like a little change. I've had some discussions with CFOs who said to me, Daryl, what the heck have you done? Because this is a judgment. So when I was doing we were doing financial statements at First Rand, the most junior person in our accounting team was given the XYZ audit company, I won't name the specific audit company, but was given their set of illustrative financial statements, and we said, go away and tick that we've done everything on that list, that all of our disclosures are the same disclosures that are on the list. Okay? And if you've done that, we're there. We sorted. We've done our disclosure checklist. We've disclosed everything that is material. Now suddenly, you've got the CFO. You've got important people who are looking at those financial statements and saying, what would I expect to be in here? It's no longer about the illustrative financials. It's about what is important to understanding my business. What is the information that could reasonably be expected to influence the decisions that people are making about my company? It's now a senior decision what is disclosed in the financial statements, not the most junior person in your team. We've also published a guide. Now, this is a non-authoritative, non-mandatory, non-required guide. It's called the Practice Note on Making Materiality Judgments. And essentially what this is it takes that paragraph on the previous page, and it gives you worked examples. It talks you through a process that you would apply in order to apply materiality. So if we're saying this is important, if we're saying this is a critical part of your decision-making process, it's important for us to give you help as preparers to understand how you actually make these judgments. That's what this guidance does for you. Importantly, it doesn't add new words to the standard. So it's not a standard. It's not mandatory. It's voluntary reading. Can I ask a question quickly? How many people in the room are auditors? Hands up. Okay, there's not too many, and they seem to be this side of the room, so I can say nasty things about auditors and then run that way. Okay, all right. An important part of this document, okay, is that it gives preparers in the room the opportunity to have a reasonable dialogue with their auditors. Auditors, it's the nature of the function, it's the nature of the responsibility they take, it's the nature of the risks they take, that an auditor will typically tell you more. No auditor yet has been sued for information that was in the financial statements. Typically they're sued for information that is left out of the financial statements. So the problem that you have is that there's a risk aversion that means you just put more all the time. The natural inclination is for financial statements to get longer. And so a part of what we're discussing here is when you should be saying no, when it is actually wrong to put more information in your financial statements. And we hope by doing that that we can balance the discussion so both auditors and preparers can have a better discussion, can have a more reasonable discussion about what should be in and what should be out. And hopefully in time, we will give auditors the ability to defend a decision when something's been left out of the financial statements. Now, I'm very proud to say that the financial market regulator in South Africa, the stock exchange regulator in South Africa, looked at our guidance and said, we're very comfortable with this guidance, this is good guidance. And so last year, they set as their project for the year, they pick one topic each year to examine more closely. They set as their topic over-disclosure. And so for the first time in South Africa, auditors and preparers started to get a letter saying, we see you disclose this information, we don't believe it is material, please explain why you think it is material. Okay, it's great because that's how you go about changing behavior. And I think it's a great thing that South Africa is doing. I think it's a very progressive thing that the country is doing with this information. We have also published a book, a little booklet called Better Communication in Financial Reporting. This is a really interesting read. All of these things, by the way, you can just download from our website. So there's particularly this one. You go into the website, you download it. What it's done is we've picked, I think it's 5 companies. I can't remember now. It's either 5 or 6 companies. We've picked these 5 or 6 companies. We've asked them if they would participate. They were very interested in participating. Each of these companies is a company that a couple of years ago started a process. And their process was to say, our financial statements are getting too hard to understand. Our financial statements are getting too long. Let's sit down and work out how to make them shorter. And each of the companies in this case study have taken their financial statements, they've made them shorter, they've made them easier to use, they've made them easier to understand, and they've done it using the words that are already there. They didn't have to, we didn't have to change any standards. They could take what was already in IFRS and they could make their standards, they could make their financial statements shorter, more relevant, better communication, easier to understand. And so this gives examples of the process they followed, how they thought about it, how they thought about the process. It draws out 7 principles that we've identified in each of these examples in terms of the way the process goes. I won't give you all 7 principles now, but I'll give you a secret to the most important one. Make sure your boss agrees. Okay. Because this is going to cost money, and your boss is going to from time to time say, why are you doing this? But all of these companies, when they look back, they said, this makes sense. This makes the financial statements easier to use. The directors like the outcome. The management feels like it explains what their business does. So it's been a really successful study for them. And we're hoping by publishing this book, what that will do is encourage other companies, other entities in the world to go out and do the same thing. The disclosure initiative itself, and everything we've been talking about is the disclosure initiative, but we also had a specific discussion paper that we published. And that discussion paper suggested a whole lot of things. We got responses back from people on how we would go about doing that. The research project, which is down the left-hand side, is what we would call this discussion paper. That research project we have now closed. We've said, okay, we've done the research. We will capture the information from the research, and we will publish what we call a project summary. But then what we will do is that in getting to this point, the project had a whole lot of baby projects. And so these baby projects that sort of came out of that project are now the ones that I'll talk about a little bit. I think this just covers the same thing. Okay, so that I'm not going to go further into that. I'll now talk about the baby projects. So the first one is a targeted level, what do we describe? Targeted standards level review of disclosures. So what that's about is we've looked at the disclosures in the IFRSs as they stand at the moment. We've understood from the way people are applying our standards that many people out there are thinking they have to produce 800-page documents. And many people think that these 800-page documents should be as unreadable as possible because that's what they think we're saying. So what the board has said, well, maybe it's the way we write stuff. And we've identified phrases. So we will say, an entity shall, and then we'll give a table. So every entity in the world goes and gives the table because it says an entity shall. I mean, well, that's an instruction. I'm not going to, who am I to say that I shouldn't do it if the standard says an entity shall? So we're looking at things like this and we're saying, okay, what we need to think about is whether we can write standards in a way that will help people better understand what we want them to do. And so we've picked two standards. IS 19, which is employee benefits, my personal favorite, I love it. So much of the disclosure that goes into IS 19 is incomprehensible and is absolutely not useful. So something has gone wrong with the IS 19 disclosure. And IFRS 13 fair value. Now, IFRS 13 fair value is a bit of a different one. There's a lot of incomprehensible disclosures that come out of IFRS 13. Unfortunately, a lot of it is necessary incomprehensible disclosures. So the reality is people need to understand how you've calculated a level 3 fair value. But the way companies do it, I mean, my whole background is financial instruments. I love financial instruments. This is the stuff I used to get excited about when I was at university. And I read the disclosures and say, what the heck are they talking about? Okay, so something has gone wrong with those two. And so we've picked those two. And we said what we'd like to do is we would like to rewrite the disclosure sections of those two standards and see if we can write them in a way that encourages people to do the right thing. It's an experiment. We're going to publish those revised disclosure sections, and we're going to say to people in the real world, look at this, think about how you would disclose. Would you change things? Would you think harder about what you put in? Would this allow you to communicate the message better? So it's an experiment, and it's an experiment to see whether or not we can achieve that by changing those two standards, and if that is the case, we can then start working on others, and if not, we're going to have to follow a different path. The next big one we've looked at is accounting policies. Every set of financial statements you ever see has lots of disclosure on their accounting policies. A lot of the time, it's telling you something that they don't have a choice about. Okay, so it says that we depreciate assets over the useful life, which we estimate to the residual value, which is the value that we estimate at this point in time would be the value of the asset when we get there. Well, heck, that's what the standard says you have to do. Why did you need to tell me that? So we're thinking about how you provide useful information in the financial statements without having to regurgitate information that's out there. So the accounting policies is another challenging one, and we're busy working on a recommended change that says you need to think about information that is material. What is material? It is capable of changing the decision of somebody who's making an investment decision or other decision about the company. We're going to give some examples to help people understand how to do this so that they can actually work through an example and understand what is a material accounting policy, with a view that using all of that together, people will be able to prepare accounting policy notes that are helpful and not boring and not boilerplate and not simply a repeat of what you can read in the big green book, or the big blue book, or the big red book. Okay, so that's what I wanted to cover on the disclosure initiative. The next 5 or 10 minutes of discussion are going to be very high level. I'm going to zip through these slides quite quickly because the objective here is just to set the scene for management commentary. I believe, if I remember the calendar correctly, that we've got about 10 minutes to go before tea. So this is just something to whet your appetite. After the break, we'll be sitting down to have a discussion, a panel discussion in more detail on this topic. So management commentary, what the ISB is trying to do here is to recognize that financial statements, the financial set of the financial statements, cannot stand alone. They can't be something that exists only in isolation. They are something that needs to actually be seen in the context of other things that are happening around. And one of the most important things that provides that context is management commentary. Management commentary takes the financial information, it takes other things, other disclosures, it takes management's perspective, it looks at the market information that's available, it looks at other requirements such as Companies Act and legal requirements and etc., and it pulls all of that together in a way that allows you to understand what those numbers really mean. And so when you get to the end, you can actually make decisions based on this whole accumulation of information. Now, the ISB's focus, now, in the past, and always, is financial information. We are not trying to become the Integrated Council. We are not trying to become the Climate Change Council. We're not trying to become any of these other people. But what we would like to do is help people understand how this information interacts with each other. Give people the guidelines for understanding how to pull everything together in one place. The couple of things that have been driving this debate, I think starting on the left-hand side, the proliferation of additional requirements that's been coming up all over the place. So I come from South Africa. South Africa's had integrated reporting for about 15 years. That's because we had Professor Mervyn King is a South African, and so when he started doing the work on developing everything and etc., he made sure we were the first ones to comply. So we've had some experience with it. It's been a rocky road. It's been up and down, but we've learned a lot of things about it. Then I go to California, and they tell me, oh no, integrated reporting is rubbish. They're not interested in integrated reporting at all. This is all about climate reporting. That's the most important thing. So anybody who does this integrated reporting malarkey must just go away, and they must rather do the climate initiative. You go to other jurisdictions, and there are other initiatives out there. And all of these things have been prepared around the financial statements, and all of them are making the financial statements bigger and longer and more complicated. So we think we need to be involved. We think there are important anchor points in all of this information, things that we can pull out, that we can say, remember this when you go through. If I'm talking climate change, or I'm talking integrated reporting, or I'm talking human resources, or I'm talking any of these other things, they have touch points in the financial reporting of a company. There is relevant to the financial reporting. So reminding people about that, bringing that together. Closing some gaps. It's amazing how many integrated reports in South Africa had financial information in them that sometimes did not agree to the financial statements. So pulling that together and making sure people understand where these gaps are and what the gaps are about is important. Intangibles. I talked about Apple yesterday. Nobody can value Apple without first understanding the value of its brand. We don't want to play in this space. We don't think, as I said earlier, we don't think right now that we should be putting a value on goodwill. But we think that there's a lot of important information about intangibles that people should be talking about in their management commentary to give users of their financial statements the ability to understand what's happening. The complementary information to understand long-term. Financial statements. Stewardship is about looking backwards, assessing how good a job management did. But everything else in financial statements is about assessing the future. How much money is going to come in? What difference is it going to make in the future? How are you going to value that? That you can only do if you understand the context in which this year's earnings are presented. And so providing that context, providing the complementary information is important. Interpreting the financial statements is important. So we think all of this plays a really important role in the way IFRS is, in providing the context to where IFRS world lives, to where IFRS financial statements live in the broader context. I'm not going to spend too much time on the next. There's now 5 very busy slides. The main objective of these slides is for you to take them home and read them at your leisure. Ideally, read them when you need to fall asleep, because they'll probably help with falling asleep. The only thing I would say is what we're doing here is we're taking the top, our current practice statement. There's already a practice statement which exists, along with all of the recent developments, the things that have happened since we wrote that practice note. And we're using that to help us understand the update. Most important thing about the update, we are still thinking that we are going to write a practice statement. That's important because it means it's not mandatory, it's not required for you to do, it's there to provide useful insight for you to think about the way you report your financials, but we're not requiring you to do anything. This is still going to live outside, for the most part, of the IFRS world. And as I say, we now go into a little bit of detail, and even more detail, and even more detail. So this is the important page, though, is to tell you now when I'm going to need you guys to start working again. Okay. So we started this process November 2017. We have put together a consultative group. Okay, this is one of the wonderful things about the ISB, is what happens is we phone you up and we say, would you like to be part of our group? And what it's a great honor. You can come and you can sit at the ISB and you can give us advice. And people say, yes, that sounds wonderful. And then we send them 2,000 pages to read. Okay? And we say, you have to fly yourself to London, and you have to spend 2 days telling us what to do, and then we'll go do it and we'll take the credit. Okay. So this is what this group is doing. They've had their first meeting. They've read their first lot of 2,000 pages. In fact, I think they've had their second meeting already. Oh, they've had all 3 meetings already. You can see I'm not on this group. They've read their 6,000 pages worth of reading. They've given us the information that has helped us in the development and the way we're thinking about this process. And so, as things stand at the moment, they've given us a lot of really useful information. We are thinking that we might have one more meeting where we'll use this to pull it all together for them. But at the very least, we're going to actually ask them to provide us with their view on the document that we're going to put out. And then we're hoping that we'll be able to publish an exposure draft by the first half of next year. That is important. It's an important date because I leave the board in the second half of the year. So if it finishes in the first half, I get to sign it. If it finishes in the second half, I don't. But it's a target. We try to set these targets. They move quite often at the ISB. But the idea is that we want to get this document out there because we believe it makes a really useful contribution to the debates that are happening around this topic. And on that note, I am just about to finish. But I'm hoping that when we leave the room, they might accidentally just leave this slide up for everybody to have a look at when we leave. So this, Doris, I see you having a close look. This is me trying to steal your staff. Okay. One of the attractions of the ISB, at a board level and at a staff level, is that we bring people from outside the organization. The idea is that people from the outside of the organization come, and they typically work for us for 3 or 4 or 5 years. You come from Taiwan, you bring the insight from your business in Taiwan, you bring the insight from the way things are done in Taiwan. You come and you work as part of the team, and as part of the team, you have the ability to contribute to the way we think. And then after 2 or 3 or 4 years, you leave. And that's typically what happens because we want people who've come in from the outside with outside knowledge. So I'm not going to drag anybody out here, and there's definitely no space in my suitcase for anyone. But if you are ever thinking about it, if this is an opportunity that appeals to you, we've always got adverts out here. And what we found is it's incredibly beneficial for us. It's really beneficial for us to get that skill set and those people and that knowledge base. It's very beneficial for the individuals who come because it's a great learning experience. It's an opportunity to internationalize your knowledge. And it's good for the companies you come from because those companies that you come from learn a little bit about, they get that knowledge back when you come back. They derive an international knowledge and an international understanding. So all I'm going to do is encourage you, leave you with this slide to go away and talk to your boss and tell your boss that this would be a really good idea to come and work. And just, this is not like a consulting group. We do pay you. Thank you very much, everybody.
Thanks to Daryl for making such an excellent and comprehensive presentation. We are delighted to benefit from your experience and knowledge. Thank you very much. We are now about to have a 10-minute coffee break. Please be advised that food and drinks are not permitted in the conference room. The panel discussion will start at 4:20.
Back to the second part of today's conference, the panel discussion on wider corporate reporting and management commentary. We are very honored to have Dr. Qi-Chun Liu to be our facilitator for this panel. Dr. Liu is the chairman of the Taiwan Financial Reporting Standards Committee. He is also a professor of National Taiwan University. Ladies and gentlemen, let's welcome Dr. Liu.
Good afternoon, everyone. First, let me welcome all our panelists come to the stage first. Daryl, Eric, Allen, Shirley, and Elila. Thank you. I hope all of you are not too tired to stay focused. Especially our guest speaker should be focused for another 1 hour. Please have a seat. Please, please. Please. Yeah. Please, please. I just talked to Daryl about today's topic about the management commentary and the wider corporate reporting a few minutes ago. I told him that most of us are not really familiar with the topic because at this moment, these are not standards by themselves. But I'm positive that this topic will definitely shape the future reporting, especially not only corporate reporting, but also financial reporting. So today we are very lucky and very honored to have Daryl with us today and 4 well-known, respected experts on this issue from Big 4 accounting firm in Taiwan. I think I don't need to introduce Daryl again, but let me first introduce our guest speaker here, our panelists here first. Sorry, I have. On my left, Eric Go. Eric Go is the head of Hsinchu branch of EY in Taiwan. He has served in EY for more than 20 years. In addition to the auditing services, Eric is also the head of the professional practice group and the Ifrs help desk in Taiwan. Eric has extensive experience in auditing service with clients, primarily from technology industry, including semiconductor, IC design, electronics, and manufacturing companies. He served a number of clients. Some of them are both US SEC and the Taiwan listed company. Welcome. Thank you for coming. Thank you. Please give him applause. Thank you. Sorry. The second one, the far left, Alan Yu, please have a seat. Alan is the head of branch office of KPMG in Taiwan. With Alan is specialized in financial statements audit under Ifrs and the US GAAP reporting frameworks. Initial public offering in Taiwan and the USA, Ifrs and the US GAAP. Alan holds a lot of positions, including the head of branch office of KPMG in Taiwan, and also the deputy CEO, and also head of audit, head of department of professional practice, and the risk management partner of KPMG. Welcome. Thank you very much. Thank you. As you can see, all of our guests here are really experts on this, on accounting and working for this, for the reporting for a long time. And on my right, the next one is Shirley Chung. Please have a seat. Please have a seat. Shirley Chung is the partner of Ifrs team based on the audit and the advisory division of Deloitte and Touche, Taiwan. She has been providing services to high-tech companies in Hsinchu Science-Based Industry Park and assisting clients issuing ADR, GDR, and the ECB. Shirley Chung has been delegated as the firm's cross-border practice leader to control and monitor the firm's risk management for non-US cross-border transaction practice for many years. Thank you. Thank you for coming. The next one is Eliza Lee. Please have a seat. Eliza Lee is the leader of Capital Market and Accounting Advisory Services and the leader of Sustainability Service at PwC Taiwan. She is also the Ifrs consulting specialist of PwC, working with Taiwan regulators and the company to adopt Ifrs. As the leader of the Sustainability Services, Eliza has extensive research and experience in sustainability reporting, including GRI reporting. And she also focuses on the implementation of TCFD Task Force on climate-related financial disclosure, impact valuation on environmental and social activities, as well as SROI, and the non-financial information for corporate management to make integrated decisions and then integrate reporting of sustainability. Thank you for coming. Thank you. Sorry for the long introduction. I hope I didn't take too much time. Thank you. As we all know, we heard Daryl talk about the many projects related to communication, related to information quality. And today's topic is related to management commentary and wider corporate reporting. And as we all know, we have observed growing support for a wider corporate reporting over years. And for example, in 2011, the Financial Reporting Lab under Financial Reporting Council in UK was launched. You can imagine it's a lab, accounting lab was launched in UK several years ago in 2011. And in that project, they hope to provide an environment to help investor and also company to develop a better way to improve the presentation and the disclosure, and hope to improve the effectiveness of financial reporting. And this year, in Europe, there's another lab established. It's called European Corporate Reporting Lab. And it's a big milestone, I think. Personally, I think it will definitely shape the future of corporate reporting. And in that project, they hope they can bring more diverse stakeholders together to discuss and share good practice, as I may. And so you can see a lot of accounting profession just thinking about financial statements, also ISB also. But in fact, a lot of stakeholders call for more information, not just financial information. And so my question letter, I will ask all of you to think about more deeply the role of ISB in the future in terms of information provided in the market. But I know you must be a little bit tired. I will proceed the session as follows. First, I will let 4 of our experts from Big 4 Taiwan accounting firms to say some words or give some remarks on the topic first. Then we will have some time for question and answers. Okay. So first one, let Eric, please. Eric. Please give him applause.
Thank you, Professor Liu and Mr. Scott, and Professor Chen and the Chairman. Good afternoon, ladies and gentlemen. Thank you for being here. In every presentation, the opening moment is usually difficult. So let me just jump to the topic. Okay, the global economy. The global economy is in constant movement. To survive and to succeed within it requires timely interpretation of the changes. If we take a snapshot of the 20th century's economy, we can see companies define values based on sorry? What's wrong? Oh, okay. Is the laser? Okay, this is the laser. This is kind of not fair. I cannot point laser over there. Okay, you have to depend on your own, right? Companies define their value mainly based on tangible assets, resulting in the product-driven economy. But if we look at the 21st century, we can see value are mainly from intangibles, which result in what we say knowledge-based economy. Intangible includes, everybody knows intangibles includes R&D, intellectual property, brand value, and the human capital, and so on. It's been said survival and success in the 21st century requires efficient management of both tangible and intangible assets. But intangible assets particularly, the efficient management of intangible assets has become the new focus in the 21st century. And this one is even more clear. Within the 30 years time frame from 1975 to 2005, based on S&P 500 study, the components of market value has, in the 30 years, the components of market value have completely inverted. Let's look at the 1975. 83% of the market value was from tangible assets. For intangible assets, only 17%. Whereas in the 2005, we can see only 20% was from tangible assets, while 80% was from intangible assets. This clearly proves that investors no longer rely on corporate financial reports to evaluate companies' value. I'm an auditor. Well, I'm confessed. I feel sad to say that, but that's true. That is because current accounting standards do not reflect the true value of intangibles, and do not reflect the entity's ability to create value in the short, medium, or long term. Obviously, the formula value, the value of formula has changed. In the 21st century, the formula for value has broadened and occurs within three-dimensional surrounding. That is surrounding, society, and the environment. Value creation in the 21st century requires a delicate balance between a diverse range of scarce resources, both tangible and intangible, some of which are owned by the organization itself and others which it must take from the surrounding environment. As I say, current reporting framework are incapable of measuring and the reporting value created in the 21st century. Then you may ask, what's missing? Well, a study shows that a study has helped identify the information gap. First, missing link between current reporting and business strategy and the link. The second, insufficient and irrelevant non-financial information in current reporting. And the third, essential quantitative KPIs are barely recorded in traditional reporting. Obviously, something has changed. We have to adapt. We have adapted to the changes. We have to do something different. We have to break down all the silos we used to have, and we have to identify all the elements that may have impact on our strategy, on our value that may, on the value that will be created by the organization, and we have to discover the discrepancies between these elements, and we have to integrate all these elements into one channel. That has been said, we have to do integrated thinking. By adopting integrated thinking, then we generate integrated report. An integrated report is not a mere compilation of financial report plus the sustainability report. It does, however, build on the various existing reporting practices by integrating material, financial, and non-financial information into one concise communication about the value created by an organization. Something wrong. Okay, this one's right. All right, there are several capitals that might have a significant impact on the value on our strategy on an integrated reporting. The financial, we are familiar with this. That's the money. That's the investment that we have. Manufacture. That's the property, plant, and equipment or inventory. Intellectual, okay, that's intellectual property, the intangible assets. We have been very familiar with these three because these three have been reflected in our current financial report. Okay, and the next one, human, that's the people, that's the team that you have, and that's the team's competencies. Social and the relationship. That's the relationship your company, that's the relationship that your company maintains with the network, with your government, with the community. Is this important? Yes, this is of course important. Is this reflected in our current financial statement? No, it's not. Okay, natural, including renewable and non-renewable. These three are not reflected in our current financial statement. They have been included. We all know they have been included in goodwill. When preparing integrated report, we have to take all these important capitals into consideration. Now, what is integrated reporting cycle? The integrated reporting cycle depicts the process involved in all elements of integrated reporting. It first begins with the organization environment analysis. At this point, an organization asks itself who it is and where it wants to go. And then a materiality analysis on all relevant aspects, including stakeholders' views on materiality. Okay, in conclusion, an integrated report is not merely a compilation of financial information. An integrated reporting combines financial with non-financial information. and shows the linkage between the different forms of value an entity creates. EY has a differentiated, forward-looking perspective of integrated reporting as specified on the slide. In our perspective, integrated reporting provides the organization with a platform to monetize the economic, environmental, and the social impacts of an entity's strategy. This is my short presentation. Thank you for your listening. Thank you.
Thank you, Eric. Now, please, Ellen.
Professor Liu, Mr. Scott, Principal Chen, Chairman Wong, and all the distinguished guests, ladies and gentlemen. It's my pleasure to represent the KPMG Taiwan to have such opportunity to deliver the firm's observation on the topic today, a wider business reporting. Is this my slide? Yes. Okay. Could someone help me? Okay. Yeah. Actually, when we look at the topic today, we did notice that we believe the current standard scoping for ISB, we did encourage or suggest it might not just limit the standard revision project to how and where to disclose IFRS information, because we believe representing or reordering the current set of financial disclosure might not really meet the expected needs. We suggest maybe we should more look at what information should be disclosed and explain why. And we know it's a long road to go, because in order to understand what the information needed by the primary user of financial statement, actually need to have the investor community to get their consensus in order to let us get the real answer. And take a few examples. Take a pharmaceutical company's financial statement or annual report as a basis. For a pharmaceutical company, I guess it is unlikely to have the disclosure related to R&D expense and the development costs being capitalized to let the user of investment for that sector to really understand why it's past the financial performance and to expect what's the future prospect. Instead, pharmaceutical company used to provide a lot of discussion in their annual report in related to the progress of their patent filing or their regulatory approval process. Take another real example of mine. In the past 3 months, as an auditor for 30 years, I only know auditing and financial accounting. But I was called by several CEO and chairman of my network equipment company to ask me build up some team, help them to resolve a very urgent challenging issue, where to add production capacity outside of China within a very short period of time. We dare not to say relocated our production capacity out of China because it's gonna upset the big brother next door. Yeah. So they're asking where to go and why go there and how to execute their capacity relocation or adding a policy. And I bet in the following 1 or 2 years, you can see a lot of Taiwan's electronic company, their annual report, they're gonna a huge page, a lot of page description about their operating site selection, because such selection, such policy gonna impact and explain their 2019-2020 performance and the financial prospect of the company in the near future. So therefore, for IFRS information alone, everybody knows it is not a complete set of information sufficient to meet the primary user of financial statement, which is relevant and useful. It is a basic foundation, but it is not enough. So we also, the KPMG as a firm, we also suggest the ISB could think about during the project, you think about to develop a whole disclosure framework, just like conceptual framework, because to play it as an overarching guidance for the standard level disclosure requirements. And such kind of framework should based on financial statement users' expectation and let each standard levels financial statement disclosure requirement to have a clear, solid, concrete disclosure objective. And take some illustrated example to explain how such kind of disclosure might meet the user's need. This is the first thing I'd like to mention. And the next slide, in the following few slides, I'd like to share KPMG's survey of business report conducted in 2016. KPMG conducted a business annual report survey in 2016, covered 270 larger listed companies in 16 countries. And the financial sector covered around 15 sector, excluding financial service industry, because as we know, it is highly regulated and there are always a very special disclosure requirement in financial service sector. So I would like to share some of our observation. Based on our survey of the 270 listed company, 52% of them actually already disclosure non-GAAP measures, such as operational one, non-GAAP or forward-looking. For example, for telecom company, more than 43% of telecom company, they did disclose their customer retention rate or even customer satisfactory score is common observed in telecom company, which is an operational measure. But as what Daryl already mentioned, such kind of non-GAAP measure is usually did not have a very transparent, clear definition. So it will be some technical issue we need to face in the near future. Secondly, when we look at the annual report's content, we believe we did also concur with the both architecture of how the GAAP information and non-GAAP information should well fit together in order to provide meaningful information. And we did also perform some survey. Based on the survey, we noted that the average length of listed companies' annual report, the page is, Ms. Barrett, not 800, but 204. Yeah. But out of those 204, 42% of them actually is devoted to what? Financial statement. Appreciate Big Four's hard working every year. We used to provide financial statement template to our client, and then the client plug in their company name, plug in the number, and then you will very fast tracking financial report generating process. So it's a lot of boilerplating wording in the financial statement. And so out of the whole annual reporting, only 15% is contributed to performance, and 14% is contributed to business model and the strategy. As what Eric mentioned, nowadays, for the capital market plays a value for a company, more than 80% of them actually is related to intangible, which a lot of them actually is derived from business strategy, business performance, something that kind of information. But currently, the content of the company's annual report actually devote to less relevant information about a company's value, a company's long-term viability, a company's long-term health. So this is something I guess we concur with Ms. Daryl's observation. There should be something to be done in the near future. Next, about we believe that in order to provide a sound foundation of a business report, the effective and the concise description of company's specific business model is a basis which will bring the whole linkage of the whole business report, including financial statement. Just as we look at here, the operating side normally in the past few years might not be a major focus of listed company. But as I mentioned, because the China-American trade war, so we can expect a lot of high-tech company in the near future, operation side, selection strategy, and execution effects gonna be a major focus of a company's annual report in the near future. And that's based on our survey about the risk disclosure. We noted that for large listed company, the average risk number disclosed is 14. And which countries' annual report disclose the longer list of risk? Guess, Daryl, as we mentioned, which ERP system is most comprehensive and most strict and most rigid? Guess, which ERP system? We all say SAP, right? Which country designed SAP? German, yes. The most the largest number of risk disclosed in average is from German, 31. US, 24. Thanks to those smart Wall Street lawyer and class action burden. So in the US, people tend to disclose everything they feel threat from the future lawyers' challenge. So 24 risk in average was disclosed in US capital market. And the last one is from Malaysia, 3, Hong Kong, 5, Switzerland, 7. So actually, the number of risk disclosure is not really meaning. The meaning is whether the company could really focus their attention on the most significant risk that will impact the long-term viability, long-term health of the company. So we believe the risk disclosure should place some balance on long-term viability, long-term health of the company. For example, the customer satisfactory, customer retention, strategies, selection, or change management, that kind of thing. Based on our survey, less than 10% of company disclose information related to this area. Next, related to strategy disclosure, we also observe the top 5 strategies being disclosed in those sample company we observe. Most of them are related to short-term, organic expansion, efficiency, and product related. But for the longer-term strategy, which actually is critical to a business health, like the company's reputation, how the company manage their risk profile, or the MMA policy, actually always be the bottom of the priority in business reports disclosure. Therefore, in conclusion, based on our survey, we believe there are 6 must-do for the better business reporting. The first is keep the report clean and relevant. And second, give the investor the information they need and provide long-term view using operational KPI. And next, provide practical KPI that align with their strategy to enable users to assess the execution success of their strategy execution. And also provide deeper analysis of the company's strategy. And the last one is put focus on most significant risk rather than spread everything just purely in order to comply with regulators' expectation rather than users' expectation. The last one I'd like to mention is, since we are all agreed at this moment, IFRS information should be combined together with non-IFRS relevant information in order to make the full financial statement disclosure or annual report more relevant, useful to investor. But over the process, we still need to think about the high quality and the consistency of non-financial information, because without clearly meet this challenge, it might bring serious economic consequence. So that's something that I would like to suggest Daryl and ISB should closely work with IAASB. Just like US, the SEC plays a lot of guidance related to how the auditor role in MD&A, in financial forecast, and in overall business report. This should be something to justify the high quality and the consistency over the all relevant information. And the next few slides is related to integrated report. And I know my good friend from Deloitte and PwC will mention that a lot. So I will save my time for those two ladies. Thank you for your listening. Thank you.
Right. Thank you, Alan. Now, please, Shirley.
Good afternoon, ladies and gentlemen. And I'm Shirley Chung, representing Deloitte Taiwan, to share our observation on the topic regarding wider corporate reporting and management commentaries. Okay, these are the four main changes that I'm kind of going to highlight that will really impact the corporate reporting. The first one will be the increasing gap between the price to book ratios. I think we all know that the company's EPS, the PE ratio is a lot higher than the earning per shares. So the nature of the risk and opportunity facing the corporations has changed over time. So much of the global value today is more technology, service, and knowledge-based than it was 40 years ago. Therefore, the information that is not captured in financial statements, such as intangible resources, what Daryl mentioned, Coca-Cola recipes, the rights for Coca-Cola recipes, and some of intangible relationships that could indeed provide a very great insight into the company's long-term success. And that ultimately will affect the entity's financial performance and their financial positions. A factor cited as evidence of increasing and irrelevance of traditional annual report is the gap that I just mentioned about the price and book value of listed companies. The contribution intangible asset marked to the S&P 500 companies has grown from 17% in 1975 to 84% in 2015. So general purpose financial statement indeed contains more than just a balance sheet. There's a lot of insight that really create the value for the companies. Therefore, a market premiums inside this intangible values. That means that investors really rely more on the information outside of the balance sheets. Although it is not always appropriate to monetize the dollar amounts, but some information about this intangible information may best to capture by income statement or by other informations. Also, the needs for broader information, such as information regarding the governance, the employee safety, and the social responsibility, those are also very important information that can reflect the expectation that the company have an obligations to behave in a responsible manners. For non-financial informations, I guess for those non-financial information to support the financial statement is also growing in importance. The problem, just like Alan said, is that there are few standards for this type of information, and for some such information labeled as a non-GAAP information with a negative connotations. Therefore, developing standards or agree industries standard for some of these major and to incorporate those in the general purpose of financial statement will really help lift their credibilities. For technology, just as the developments in technology have changed the way we assess and Fed news, technology will also change how investors and others assess and consume corporate informations. And therefore, the company also need to consider to embed those technology innovations to share information quickly and to a wide audience and to allow investors to assess and how well a business is doing. From the survey, we also, Deloitte also performed a survey in 2018 on the annual reports. The comment on this survey of TFSE corporate reporting based on a review of annual report of 100 listed UK companies, you can see the proportion of narrative contents is 61% of the report as compared to the financial part, which is 39%. This emphasizes the needs to consider the materiality in the contents of narrative reporting, as well as financial reporting. Since the annual report is really a place where provide information through the management's eyes and allow those responsible for running the business to present their assessment of company's risks and opportunities that the business is facing or is faced. Therefore, I think a single set of robust principle or guidance, not the detailed rule, but the principle or guidance governing the quality and preparation of this narrative reporting is very important. And okay, and also there's a bunch of potential benefits as well. Having one set of principle governing the quality and the focus of narrative reportings, such as particularly for dual or cross-border offerings or company worldwide, having a set of regulation to governing those, how do you present the narrative reporting that can really reduce complexities and provide greater transparencies and increase comparability and improve efficiency. And best of all, is able to lower the cost of capital by expanding the base for global fundings. And so knowing that the ISB is undertaking the management on commentary and the wild corporate reporting project, and we all share from Mr. Scott to the information about this the purpose of this project. We indeed love to see the trend and the workforce to set a foundation for all the global regulator to consider and to adopt. But at the same time, since we are providing all this more future-looking and more like how companies' business valuation creation sort of information, I think the opposite side of that will be how do we present and address this information in such a way that it's not too aggressive, that really in turn provide a very negative investment decision for our investor. I think that will be also need to consider when this project is undertaken. So that's about my presentation. Thank you.
Right, thank you, Shirley. Now the next one, Eliza, thank you.
Hi, ladies and gentlemen. I am Eliza from PwC Taiwan. I'm the last presenter from the before. Are you all awake and stay focused? Are you? Thank you very much. And today I'm going to share with you my observation regarding reporting on what contributes to longer-term financial return. And I think my first observation is that what what are the expectations from the capital market? As we can see, today's capital markets are expecting more and more from the corporate reporting. First of all, they expect that the corporate reporting can share with them how company measure and manage intangibles in addition to financial return. Intangibles such as human capital and such as relation capital and also such as environmental capital. They also expect that the corporate reporting can tell the investors how company create value in addition to profit. Also how company allocate their resources so that they can provide information for the management to make informative decision to wider stakeholders, not just shareholders, like customers and like employees, so that the corporate reporting can tell all the stakeholders how they can sustain with longer-term success. That's the reason why there are more and more mandatory reporting from capital market. In addition to annual report, the shareholders report, in addition to Ifrs report, and now there are more and more capital market requiring sustainability report, or CSR report, corporate social responsibility report, or ESG report, environmental, social, and governance report. Why sustainability reporting or ESG reporting is important? Why? Recently, in April, the IASB chairman, Mr. Hans, he gave a speech in the climate-related financial reporting conference. And in the speech, I have a few key takeaways here to share with you. First, one of the focuses of updating management commentary practice statement is to include sustainability issues or ESG issues. Secondly, because IASB is the IFRS financial reporting standard setters, so the key focus will still be on how sustainability issue might impact future financial performance. And one sustainability reporting guidance Hans mentioned has come very close. The disclosure framework has come very close to that of IASB, which is TCFD, Task Force on Climate-Related Financial Disclosure. We will talk more about TCFD later. And the last, Daryl also mentioned nowadays there are many different sustainability reporting by different standard setters. And there are too many, so it's a bit too much for all the sustainability reporting readers or investors. So now the first step is to consolidate all the sustainability reporting through the corporate reporting dialogue framework. And there are many different organizations in this platform, including IASB and also FASB. Next, to talk more about TCFD. But before that, I would like to share with you this slide. Climate is changing. Are business prepared for the change? You all have heard about climate change and global warming, which caused the melting of glacier and also rising of sea level. The polar bear here is trying to help his friends to become a panda. Why? Because polar bear has no food to eat, has no place to stay. To help his friend to become a panda living in the mountains and having bamboo leaves, so panda doesn't need to worry about the global warming. It's cute, but it's also sad. So not only polar bears are affected, countries and business around the world are also affected by global warming. There have been losses from the natural disasters, like we can see, all the US dollars are flown away by this hurricane. In 2017, US incurred about 300 billion US dollars loss. That's the record height. And also, there will be losses from companies if they are not able to transit to low carbon economy. For example, from this news headline, you can see that Taiwanese government actually stopped companies from selling refrigerators or air conditioners that cannot maintain certain energy efficiency level. But opportunities come with risk. If your company are selling the electric cars, then congratulations. Because in the world, there are many countries actually stop companies from selling gasoline cars or diesel cars. So for companies sell electric cars and also all the product services to support the use of electric car, we are expecting their revenue to grow along with all the regulation of promoting electric cars. And also, many countries in the world are actually promoting the use of renewable energies, including Taiwan and China. So if you are in the business relating to wind power or solar power, then congratulations. You are also expected to grow your revenue arising from all these low carbon products or services. And there are so much financial impact from climate change, but do we have enough information? Do investors have enough information to make their decision on company who might be suffered from climate change? Do company management have enough information to make their climate-related strategy decision? No, they don't have enough information. And that's why when G20 are gathered together in 2016 in China, the finance ministers from all these countries actually asked Financial Stability Board to draft the guidance on climate change financial impact disclosure. And they also expect the financial impact from climate change to be disclosed similar to financial information, so that company management have the information to monitor and manage climate risk and opportunity. And also with the disclosure, banker, insurer, and investors have the information to make their decision whether they are going to invest in this low carbon product company or provide insurance for companies who are under higher climate risk. And actually in this guidance, it also discloses the amount of financial impact from the climate change. Say from now to the end of this century, the global manageable assets at risk due to climate change estimated to be $4.2 to $35 trillion. And for energy sector, if they are going to transit to low carbon economy, it will cost them $3.5 trillion each year to transit to low carbon economy. You may be wondering why we are expected to disclose the financial impact from climate change. Where are the financial impact come from? And as we explained earlier, or the example we talked about earlier, there are risks and opportunities that might cause financial impact. For example, if the company are not able to follow the government regulation to transit to low carbon products, or if the extreme weather become more and more serious and it's either too hot, too cold, or too much hurricane, that will also cause the loss from the extreme weather. But the opportunity also comes from all the different products or services relating to low carbon economy that we talked about earlier. All this will have financial impact on our revenue, on our R&D expenditure in order to catch up with the low carbon economy innovation or technologies. And if our PP&E are not able to produce low carbon products, then the PP&E might suffer asset impairment. And our capital and fundraising costs might also be higher under the climate change risk. All this will, in the end, be reflected in our income statement, in our cash flow statement, and also in our balance sheets. And this will be related with us accounting people. I believe the ultimate objective of TCFD is actually to help the cash flow to lead the way, lead the global to go to the lower carbon economy. So TCFD actually asks companies to analyze climate risk and opportunity and to assess the financial impact under different scenarios so that the company can form their climate strategy, form their goals, KPIs, and action plans, exit these action plans, and continue to improve, and also disclose the financial impact from all these action plans, and they need to adjust their climate strategy or action plan if needed. On top of this, all this need to be done together with company existing governance, risk management, and operation structures. With all the climate financial information provided to wider stakeholders and regulators, and more importantly, the insurers, lenders, and investors. Insurer, lenders, and investors are willing, because they have the information to make decisions, they will be more willing to do investment to or loan for renewable energies or energy-saving PP&E. And insurance companies are more willing to provide insurance to companies who are under higher climate risk, so that all the companies will all work together in the world to lead us together to low carbon economy. Although G20 have not actually all required the mandatory reporting according to TCFD, international financial service providers are actually ahead in terms of TCFD reporting. For example, ASA, this is the International Insurance Group, they actually disclose in a separate TCFD report about their financial impacts from their equity portfolio, the negative impact and also the positive impact from green technology opportunities. And the information also include their bond portfolios, their positive or negative impact, and also the potential flaws and wisdom loss on their properties arising from climate change. So, I have been in accounting and financial reporting area for more than 30 years. I believe in the future, financial return will still be the most important information for investors to make investment decisions. However, I also believe it will not be the only factor that investors will consider. So as accountants, we can work together with other standard setters and to lead the focus on sustainability issues that could impact the future return, support company to disclose to investor, lenders, creditor, for them to make decisions based on longer-term value that the company can create. And with all this, we as accountants, we actually are able to empower corporate reporting to lead the creation of greener and more sustainable global economy. I think that's consistent with the 17 Sustainable Development Goals that United Nations promoted since 2015. They want people partnering together to work on the peace and the prosperity of the planet. So as accountant, we can do our part. My ending message is that with the power of accounting and financial reporting, I believe we can help to let the money do more than just making money. we can lead the money to stop the earth from being flooded. We don't want the flooding earth. We want a green and beautiful earth. So at the very end, you and me and the ISB and the wider corporate reporting together, I believe we can help to save the world. Thank you very much. This is PwC from Life.
Thank you, Shirley. I believe Daryl must be anxious to say something about the topic, but because of time strain, let me raise the first question. Then you can add anything you want to say. My first question is related to the law of management commentary. ISB states several times that management commentary is principle-based, non-binding approach. It's a non-binding approach. Then my question is that if management commentary is to provide context for understanding financial statements, then it must be important, and it must be critical for investor or other user to understand financial statements. So my question for you and other guest speakers, panelists is why the ISB still adopt the long-binding approach to management commentary. If it's possible, it will change in the future. Do you think so?
So I think let me answer that in two pieces. Firstly, let me say I thoroughly enjoyed all of the presentations, and in terms of a takeaway from the presentations, that perhaps financial information is a core that we start with, but there's a lot of surrounding stuff that we need to be thinking about. I think that fits with the way I'd like to think about it, and I loved Liz, particularly the way you finished with your presentation at the end. I think shows the importance of it. From a mandatory versus non-mandatory, I think that the way the ISB is thinking about this at the moment is that we believe we have a very good skill in working on that core. We understand the financial information exceptionally well. We've developed financial information that fits in a broad international context that works really well. We think that when we start moving from financial information to management information and beyond that to some of the additional frameworks that we've talked about this afternoon, different environments become far more significant in different jurisdictions. So Taiwan as an island nation might look at things very differently to other nations in the world, for example. And so we believe that we can play a critically important role as a persuasive influence. And what we would be encouraging is we'd be encouraging local jurisdictions to look at what we've provided and consider adapting that to local situations and then making it mandatory. But we don't think we yet have a key that unlocks a solution that would be internationally workable in a mandatory space. To the second part of your question, do I think that will change? I certainly think this is an evolving space. I think I mentioned that we'll be looking at an exposure draft. I think one of the important parts about that exposure draft will be to ask people whether they think this should be mandatory. I suspect this might be a project that we revisit in 5 years or 10 years' time, and by then sufficient international consensus about what good non-financial reporting looks like may have developed enough to allow us to be firmer. But right now, my perception, my view would be that we're likely to stick with non-mandatory because of the fact that there isn't a consensus around the absolute solution everywhere in the world.
All right, thank you. Does anyone want to add? Can I follow your response to this question? The reason why a lot of criticism about the non-financial or corporate reporting in management commentary is that it's very difficult for investors to compare among countries. And as you just mentioned in conceptual framework, the quality of information depends critically on relevance and also comparison among countries. If it's not binding, if it's not required, although we can use step by step, encourage more disclosure, and not just, a lot of companies just don't disclose any important information within management commentary. So my question for you is that it's possible, like risk disclosure in financial instruments. At first, they just encouraged companies to disclose, but within a few years, they started require some disclosure. So my question for you is that does ISB think about in a long-term approach, not just finish the management commentary, just step by step?
And I think that's probably exactly the way we would be thinking about it. So, I mean, firstly, it's worth saying the work that the Task Force on Climate-Related Financial Disclosures is doing, I think, is really important work, because in part they are looking at whether or not you can combine these different frameworks and achieve a sort of an international consensus approach. Now, the ISB approach would be to say, well, we know there's a lot of good work going out there. We don't necessarily believe we have the expertise right now to pick the winner. To say, oh, that's a better framework than this one, but we do think that the good work that's going on out there, combined with the type of guidance we give, combined with the fact that we know, for example, stock market regulators and others very closely follow, and I mentioned the South African example. In South Africa, this is already mandated by the stock exchange. So we think we can sort of grow it over time. Now, perhaps we're hoping at the moment that at some point we can hand this over to somebody else and say, you take this and complete it, here's the initial work. But I think if we found that nobody was stepping into that space, I think increasingly we would be interested. And again, you mentioned in your speech, Hans's speech, my chairman. My chairman is probably more enthusiastic about this than I would be, for example. He would like to see it mandatory. He believes that we can get there. I think I would take the view that I'm a little bit more cautious. I think we need to take a little bit more time to get there and sort of develop that consensus over time.
Thank you. Because we're almost out of time, let me have one more question, maybe for you or for our panelists, is that Chairman Hans Hugovest stated in many different occasions that the ISB don't have any expertise on non-financial reporting, and accounting is accounting involve a lot of different expertise, including for example we disclose information about financial instruments, disclose information about as you just mentioned, pension, a lot of different specialty. So my question is that even though the ISB doesn't have the expertise right now, but they do have the right or power to ask company to disclose. So so my question for you is that if you think this information is material important, why not just ask company to disclose and to learn from this process? Yeah.
And I think maybe a part of this is going to be important to see is what the final shape of an exposure draft that we develop is. I think if an exposure draft can be, if we find that we can get the words to make the concept of non-financial information clear, without having to, as the phrase I used earlier, without having to pick a winner, I think that would move us closer to the idea of making it mandatory. But if we find that what we have to do in order to portray this message, in order to get the message across, we have to be very specific about what that disclosure is, then I think the difficulty is we need to wait for that consensus to develop about what is important. I mean, I think, and as I said earlier, if you've heard Hans talk, you would hear that he's very passionate about this. We would love to find a solution for it. But I think we accept that we have to take baby steps along the way to develop, to bring people along with us. The risk that we find as an international organization that to a large extent is a voluntary organization, nobody has to accept IFRS. It means that we have to bring our constituents along with us, and I think this is a very good example of that. At the same time, and I'm going to advertise again like I did earlier, this will be an exposure draft, and I think once you see the words in the exposure draft, if you look at those words and you believe actually this could be a mandatory framework and you believe, then I think that's very good feedback to give to us, and you'll make my chairman very happy.
Thank you very much. We are really out of time. We don't have time for any more questions. But you know, I will follow my question later, maybe tomorrow. Thank you very much. Finally, I would like to thank all of our panelists here and to give us a lot of insight into the issue. Thank you very much. Please give them a big round of applause. Thank you very much. Thank you.
Thank you, Dr. Liu, Mr. Scott, and all of the distinguished panelists for devoting your time and sharing your views with us. Ladies and gentlemen, the aim of this conference is to allow us to better understand the development of the IFRS. We have all benefited from this conference. This is the end of the 2019 International Financial Reporting Standards Conference. Thank you for your participation.